fast.
It can't go too fast, but there is a bigger question here, Tom, about fiscal stimulus as well, not just what they're doing on the monetary side here. I know that there's been some reluctance, at least of what they've expressed publicly here. What do we know when it comes to the fiscal stimulus side of this equation?
So the challenge, Romain, is that whilst China isn't quite maxed out on stimulus, they do have significantly reduced space relative to that they enjoyed in past downturns. So if you think about 2008 in the global financial crisis, if you think about European sovereign debt crisis, other periods of weakness in the Chinese economy, they've dashed out with significant rate cuts, significant fiscal stimulus, significant encouragement to state-owned banks to lend and state-owned enterprises to invest. That's now left them with a legacy of significant overcapacity in industry, overcapacity in property, and really high debt on local governments' balance sheets in particular. What that now means is that as growth fades in 2023, and we are looking at a pretty sharp deterioration in momentum in the latest data, there's just a limit to how much they can do. That means we saw the PBOC move with just a 10 basis point cut in the MLF, and that's why expectations on the fiscal side are also pretty limited.
I am curious here about just the overall health of the financial markets here. We started the year, we saw Chinese stocks basically rally about 10% or so just in the first month of this year, and of course since then it's pretty much been kind of a slide down, down roughly 20% here from some of those highs back from last year here. And then we saw the suspension apparently of a couple of writers who dared to actually criticize the performance of the stock market over there.
Yeah, it's interesting, Romain. So there's two pretty significant challenges for China stocks right now. The first challenge is growth, right? We've gone from a Chinese economy which was growing at 10% a year not that long ago to a Chinese economy this year which will probably grow about 5%. So that's a growth rate which is halved. And most people think that's going to slow down further in 2024 and beyond. And we've got a government which is saying, you know what, we're going to pay more attention to the needs of workers and families, and that's going to come at a bit of a cost for entrepreneurs and investors. So you've got those two structural negatives for the stock market. And what's the government doing? The government's saying, okay, if you send a nasty tweet about the stocks, we're going to kick you off our social media platforms. So kind of killing the messenger. Is that going to change the kind of fundamental market view, the sort of fundamental structural negatives for Chinese stocks right now? Probably not.
All right, Tom Orlick there, chief economist for Bloomberg Economics, a look at what's going on over there in China. A lot more coverage coming up here on the program, including the look at U.S. antitrust laws. In fact, we talk about this idea of that merger slump, the slump in M&A. Well, the deals that are going to get done, it could actually take longer to get done. An interesting filing coming out by U.S. regulators just a while ago. We'll discuss after the break. This is Bloomberg.
Steve's ability on the course may not be etched into any record books, but following him around, it's clear that it's not for lack of trying.
Jeez.
We were constantly hustling behind him as he caught up with executives in the portfolio companies and reminisced with former and current players.
He's a day trader. He called himself self-made day trader. Yeah. And so he's on the bus after a game in New England, and he's day trading on the bus, and Bill Belichick sees him and cuts him on the spot.
You know, in many ways, it's a convention, right, of the people that I don't see maybe once a year. And so it's kind of all come together. My firm, our charity, our fundraising efforts, and then the friends that are around. My dad and my brother, it all happens right there as a confluence of all these parts of my life that have found its common center.
News breaks. No one covers the world like Bloomberg.
The image of Vladimir Putin as the all-powerful leader has been rattled already.
History was made here at the federal courthouse in Miami when Donald Trump became the first ever former president to ever be arraigned on federal charges.
We're going to need a new engine technology, and that's where the real battle lies. And whoever makes that decision first is going to have a huge impact on this industry.
Bloomberg, your global business authority.
All right, an interesting filing here in the United States just a little while ago by the major U.S. antitrust agencies, an overhaul here of some of the merger review rules, the first big overhaul that we've seen in at least 4 decades. Sarah Forden joining us right now from our D.C. Bureau to talk a little bit more about what this means. Sarah, does this mean that deals can still get done, or they're just going to take longer to complete?
Yeah, absolutely. Deals will still get done. And just to be clear, most deals actually get through and get approved and go forward. But the antitrust agencies are very focused on making sure they scrape out the potentially illegal deals. And so part of the way they're going to do that is by making companies provide much more detailed information at the beginning. So what the deals are about, whether there are overlaps in business units, more detailed information about the narratives behind the need for the deal, and then technical information about board directors and other factors that we're just going to take companies longer.
So this type of information was also collected, is already being collected, but it's usually done in the later stages of the review process?
No, this is part of the process of filing to seek approval. But up to now, the forms that have been used have been very much more streamlined, 1 or 2 word answers. Now the agencies are going to be asking for a lot more detail and information that actually it's surprising that wasn't required before. So in a way, they're kind of tightening up the process here as well.
So how long does this add, I guess, to the process here for those companies that are looking to file?
So the FTC itself actually estimates it could add about 100 hours to the process of filing for approval. That process currently takes companies anywhere from a week to 2 weeks. But we also have an estimate by our own Bloomberg intelligence analyst, Jennifer Rhee, who's looked into this. And her estimate is that it's going to take companies potentially much longer, even as much as 2 to 3 months, as they look into their records and collect all the information and pull this together for the agencies.
One key bullet point in this that jumped out with me was, and I'm just going to quote it here, was to identify potential horizontal overlaps current or planned. That obviously dovetails very neatly here with the sort of antitrust mission that these regulators have here. What type of due diligence would companies have to do now that maybe they didn't do in the past?
So this is actually one of the most interesting pieces because it is actually the job of the agencies to identify what overlaps are potentially illegal. And so by doing this, they're throwing the burden back to the companies to say, what should we be watching for here? And is there anything that's potentially going to cause an overlap that would hurt competition?
All right, Sarah Forden helps lead our coverage in Washington here. Interesting story on the Bloomberg terminal involving a merger review revamp by some of the main U.S. agencies here that could add months, potentially, to some of these deal filings. Meanwhile, back here in U.S. markets here, an update once again here after 6 straight days of relatively tepid price action. A NASDAQ out in front, up by about 2% as big tech does its job. Transports also higher on the day, up by about 2.5%, and Bitcoin still remains getting a bid here, and that's giving a lift to some of the stocks, including Coinbase on a phenomenal run here, now up about 10% here on the day. Meanwhile, take a look at the yen at 144. At one point on the day, it actually touched its lowest levels of the year. Meanwhile, you are seeing some, well, potential record highs, or at least 52-week highs. Meta Platform right now flirting with a 52-week high. Apple flirting with an all-time high. Home builders across the board right now at record levels. A lot more coverage coming up here on Bloomberg. Stick with us. This is Bloomberg.
London will stay a financial center. It will stay our EMEA hub. We'll just have a rebalancing onto the continent. And actually, the numbers of who has moved across aren't that big. So it's sort of in the 200 level. And if you think about 15,000 people, that's sort of not that material. And so I do think both will basically continue to grow and continue to be very relevant. What will change, though, and the big thing that's changing, is actually the risk-taking is what's going to move. And so we've historically had risk-taking in the UK. That risk-taking and the assets that go with it, not the people alone, but the assets that go with it, that's the next phase of what we're now moving into. And that will be a material change.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights.
How has that shaped your strategy for the bank?
Is this a new normal? Is this like a catalyst?
Do you think we're in a new phase for dividend policy overall?
That's a great question. I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
From New York City,
from London,
in Sydney,
from Washington,
in Tokyo,
9 a.m. in Beijing and Shanghai. Good morning, everyone.
Have a great evening.
Here's what I'm watching.
You do not want to miss this story.
Is there the kind of upside?
This is Bloomberg Markets to Close, almost 2:30 here in New York. Time to get you caught up on what's happening in the commodities space. Abigail Doolittle standing by right now with our commodities close. Abigail.
And we're seeing some real weakness, Romaine. We're taking a look at the Bloomberg the Bloomberg Commodity Index down more than 1%, even with the Bloomberg Dollar Index down a little bit. Take a look at the weakness for crude, near session lows down 2.4%. Wheat selling off by 5.4%. To the best of my ability to determine, this has to do with the fact that traders are reassessing the risks around Russia and assessing that there may not be the risk that some thought that there could be given the situation over the weekend. Gold down 0.6%, so there isn't a bid for the Haven metal. And copper, the industrial metal, Dr. Copper, telling the economy, well, it's down too, down 0.4%. But overall, Romaine, we're seeing some real weakness for commodities on the day. Sometimes that foreshadows weakness to come for equities, but certainly in the day, we're not seeing that for stocks.
Well, Elisa, thanks there to Abigail Doolittle. And as far as equities, we should point out, setting up for what could be the best day of the month, believe it or not, for the major equity indices, and a big part of that has to do with some of the economic data. The U.S. housing rebound, it does continue. Sales of new homes beating expectations in May. Third month in a row we've seen that, and it defies a lot of the concern out there that owners are reluctant to list their homes in a high interest rate environment. Danielle Hale joining us right now, the chief economist over at Realtor.com. All right, Danielle, let's first start off with new home sales. These numbers were phenomenal and quite frankly weren't necessarily a surprise. We've seen a lot of strength in the new home sales market for quite some time.
Yeah, the new home sales market has done better than the existing home sales market, in part because builders are able to build. They're less constrained by higher mortgage rates that are holding back a lot of potential homeowners from selling their homes. And so they're able to build and able to better meet buyer demand in the market. I think the real surprise has been the strength of buyer demand in the face of higher interest rates, which has created some affordability challenges for buyers, but hasn't really stopped home sales all that much, especially on the new home side of the market.
Yeah, I mean, overall, I mean, we looked at some of the CoreLogic data we got this morning, year over year, some price declines, month over month. Prices did tick up just a little bit. Talk to us, Danielle, about sort of that line between new home sales and existing home sales. And I know we get that data a little bit later, a few days away here. But is there any sort of hope that we could see a rebound for existing home sales?
No, I think existing home sales have hit bottom early this year at about 4 million pace, and since then they've been climbing very, very slowly. They're not going to see the same surge that we're seeing in new home sales because a lot of homeowners need to make a decision to sell, and it's just not really in their best interest right now, given the fact that many of them have mortgage rates that are locked in at or below 4%, and current mortgage rates are up at close to 7%, really up above 6.5%. And so that mortgage rate lock-in effect is keeping a lot of potential sellers from hitting the market. And so there just aren't a lot of homes for sale. So in the face of a lack of incentives to sell, it makes sense for them to stay put, and that's really creating an opportunity for builders. Where the new home sales number that we saw today was the highest that we've seen since February of 2022. Yeah. And even though builders are better able to keep up with supply, we're still not looking at a new homes market that's just abundantly supplied. If you look at the inventory of new homes for sale, it's at the lowest level that it's been at since February of 2022 as well. So it's still a challenging market for buyers because there aren't a lot of homes for sale, and the homes that are for sale are still pretty pricey, even though prices are dropping a bit year on year. Yeah. One bright spot for buyers in today's new home sales data was that builders are shifting towards the low end of the market. So we saw a greater share of home sales under that $300,000 price point. Wow. So that is important, especially for entry-level buyers.
Yeah, certainly. So what does that mean geographically speaking, Danielle? I mean, whenever we talk about new home sales, unfortunately, we also know that a lot of these homes are going to be built in areas that are maybe a little bit less outside the urban centers here. What did you find in the data, geographically speaking?
Yeah, so geographically, we're seeing differing trends depending on where people are. In the Northeast, Midwest, and South, where homes are generally more affordable, we're seeing home sales continue to tick up. In the Northeast, in fact, compared to a year ago, new home sales are more than double what they were, so big surge. Compared to a year ago, home sales in the West were roughly stable, so not as much building out west relative to a year ago. But for the month, in May itself, all 4 regions saw home sales advance. So that is a sign that builders are doing what they can, where they can. But some differential economic performances in the regions, we've seen stronger labor markets in the Northeast and the Midwest is playing out in the home sales data as well.
So when we go back to mortgage rates, I mean, we're sitting at what I don't know what the average is now, right around 7%, I think, depending on whether you're looking at Freddie Mac or the bank rate data here. Is there any hope here that we could see any sort of material moderation in mortgage rates to bring them down maybe to a level that stimulates a little bit more activity, particularly when it comes to existing home sales?
So we just released our revised housing forecast and outlook last week, and we expect to see mortgage rates gradually decline in the second half of 2023. It's not going to be a sharp decline like we saw a sharp climb. So I don't think we're going to see a sudden re-entry to the housing market the way we saw a pretty quick pullback. But I do think as mortgage rates come down, it's going to make a difference for more and more homeowners. It'll get them off the fence. It's not going to happen quickly. But I do think we're going to see some improvement as we move throughout the year. In the meanwhile, first-time home buyers who aren't locked into current rates and are maybe better able to save for a down payment with rents dropping could be in a good position to take advantage of the housing market right now.
All right, Danielle, always great to talk to you. Danielle Hale there, Realtor.com's chief economist here. A look at the housing market on the back of that incredibly strong U.S. new home sales data. Coming up here, we're going to head back into the commodities space and a look at what's going on with deer. Dry conditions across the Midwest giving a boost to demand for farm equipment. That discussion coming up next. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
This June, in honor of Pride Month and Juneteenth, Bloomberg brings you a special equality series every Thursday in June at 1 p.m. Eastern. Bloomberg Equality, celebrating inclusion this Pride Month.
You're so intimately linked to the future of the UK. What are you seeing when you go to branches and in the country?
Yeah, we're seeing a lot of anxiety at the moment. I think the recovery from the pandemic has been and is continuing to be very strong. So I think we're seeing the economy recover. But with rising interest rates, with inflation, those are things that, peoples and families and businesses haven't had to deal with for 10 years. So a lot of business owners today haven't had to operate in that environment. So it's causing quite a lot of anxiety, which means, for us, because we're up and down the country in branches and offices, we can spend a lot of time talking to businesses and helping them plan and deal with it. But it is, it's very different, and it's not something people have had to operate in for a long time.
From the world of politics to the world of business, every weekday at 5 p.m. Eastern Time, hosts Anne-Marie Hordern and Joe Matthew alongside Kaylee Lines deliver news, insight, and analysis live from Bloomberg's Washington headquarters. Get the latest from and about politics' biggest power players at the end of every trading day. Balance of Power, every weekday at 5 p.m. Eastern Time, only on Bloomberg, your global business authority. Today's CFOs are reshaping the C-suite, positioning companies to meet the next generation of challenges, breaking out of traditional roles.
One of the most important things is looking around the corner.
Look for Chief Future Officer on Bloomberg.
All right, let's get a view from the sell side with our top calls, the big movers on the back of analyst recommendations. And we start off with Alphabet. Its second downgrade this week. Bernstein cutting to market perform. The analysts there saying that Google's push to experiment with artificial intelligence, it's gone from too slow to too fast, which he says could result in near-term air pocket on search pricing. Shares, though, higher on the day by about 0.3%. Next up, let's take a look at Meta. Citi bumping its price target to a street high, $360. The analysts now expecting the company's ad revenue to grow 14% next year, thanks in large part to the Reels video feature. Meta platforms up 3.5% on the day, just shy here of a new 50-week high. 52-week high. And finally, let's take a look at Kellogg, the cereal maker, getting an upgrade today to buy over at Goldman with the $83 target. The analysts there saying that the company's plan to split into separate divisions that offers some potential for growth within this sector, something he finds has been increasingly scarce as pricing concerns overshadow everything. Kellogg shares up 2% on the day, and those are some of our top calls. We do want to stay in the commodity space and stick with the sell side here. A dry spell in key corn and soybean producing states. It's leading to poor crop conditions not seen since 2012. That in turn, well, it could actually boost demand for farming equipment. Mig Dobre joining us right now. He's Baird Senior Research Analyst covering Deere. And let's start off here, Mig, with an explanation here of how those dry crop conditions actually feeds through into the need and the demand for greater demand, I should say, for farm equipment.
Yes, good to be with you, Romaine. You brought up the fact that this year has been a dry year. Indeed, it has been. If you look at the main producing areas in the United States, notably the Midwest, more than 90% of arable land is experiencing some level of dryness. And in one of the reports that we recently published for investors, we compared current conditions with what we saw back in 2012. And I have to say, there are a lot of similarities. In fact, I dare say, from a dryness standpoint, just purely the amount of land under stress, we're tracking a bit worse than where we were back in 2012. This, as you pointed out, gets reflected into crop conditions. And this is what we learned yesterday from the U.S. Department of Agriculture, tracking crop progress. We have seen that in corn, for instance, the percentage of crop that was rated good to excellent was only 50%, considerably lower than the prior year and considerably lower than the 5-year average. Now, the way all of this plays into equipment demand is really through commodity prices. Commodity prices are what farmers really use to inform their investment decisions. And higher prices are really happening at the right time for them since the OEMs, Deere, AGCO, and CNH have now opened their order books for 2024 deliveries.
So the timing kind of, I guess, to a certain extent, with the overlap in timing kind of works maybe to the advantage of the equipment makers here. When you draw that parallel with 2012 here, Mig, what was sort of the end result when it came to the yields that these farmers produce, and more importantly, I guess, the money that they made off what they produce or maybe what they recoup from the government?
Right. So that's a good question. If you look at production for corn, for instance, back in 2012, production was down almost 13% due to the drought we talked about. Yet crop income, crop receipts, and farmer income were up on a year. Now, there are a lot of moving pieces here, and higher commodity prices play into it. One overlooked factor, though, is crop insurance. That's a tool that many farmers use and have been using for the past 15 to 20 years that has really provided a very nice hedge on the downside against events such as this one, drought.
So what comes next here when we talk about the demand for that farm equipment? Obviously, farmers aren't just going to rush out and replace something that maybe is already new or something that they just bought a couple of years ago here. What do we know about, I guess, the age of some of the equipment that is sitting on these farms?
The age has gone up quite a bit, and that's because of multiple years of underinvestment. The other thing to consider here are the tax implications of buying equipment. When a farmer has a very profitable year, like this one might end up being, there's a real incentive to buy equipment to enjoy the depreciation tax benefits that's associated with that equipment. And then lastly, technology. This is a multi-year story in the ag space. Precision farming is growing. And the returns that modern equipment or late model year equipment with precision technology provide for farmers are significant.
All right, Mig, great to catch up with you there. Mig Dobre, Baird Senior Research Analyst. A look at Deere has an outperform rating and a 445 price target on that stock here. Maybe some potential for increased demand off the back of poor crop conditions. Coming up, we're going to have a discussion about healthcare. Sarah London, she's the CEO of Centene, a discussion about Medicaid redetermination. She's also going to provide us with updates, which are underway. That's coming up next after the break. This is Bloomberg.
everybody want to be a consultant, and what are all these consultants doing?
Well, David, I think that we actually defy the label consultant, because sometimes consultant seems to imply that we only give advice. And when you look at what Accenture does, we're really different than the traditional version of a consultant. We're really about relevance and results, and that's what is driving our business.
What about a consulting project? In my example, I'm the CEO, I have a problem, I call you up, I say, solve my problem or give me a solution.
We don't operate as big companies permanently in crisis mode. And so when you think about like how long does it solve things, a lot of it starts with, the company being willing to set aggressive goals. And so what we are trying to do now is work with our clients to work differently and to work faster.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back. It's time now for our Wall Street Week Daily segment. The host of Wall Street Week, David Weston, joining us as he does every day at this time. A lot of great conversations that you bring to the table here, David. What do we have today?
So, healthcare, big part of the U.S. economy, as you know so well, Romaine. But we don't often get to talk to a CEO of a company that's really directly involved in administrative healthcare. And we have exactly that opportunity today. And it's Sarah London. She's Centene's CEO. Sarah, thank you so much for joining us. Good to have you here.
Thanks for having me.
So let's first of all start with Centene. A lot of your business is really related to Medicaid, which is going through something of a redetermination, as they say right now. Explain that to us.
Yeah, so Centene serves more than 28 million Americans, predominantly in government-sponsored program. Almost 70% of that is Medicaid, so state-based program. And during the public health emergency, the states held off redetermining eligibility for members to have health care coverage. That has now started again, which means there's a huge backlog of members going through that process. It's a massive undertaking for many of our states. So our strategy has been to work very closely with our state partners, actually preparing for this process for almost 18 months. And we have been on the ground, local, trying to meet members where they are, educate them about the process, ensure that they have as much access to health care as they can, and providing alternatives if they're no longer eligible for Medicaid.
So as we know, during the pandemic, the federal government stepped in and really increased the funding, went through the states for Medicaid. A lot more people got insured, as a practical matter.
Yes.
How much farther is that going to go back down now? Are we going to go back to pre-pandemic level in terms of the level of insurance for people?
I don't think it'll go all the way backwards. Our view is that there are folks who were continuing to be eligible for Medicaid during that time, so we won't entirely revert during this process. But again, it's millions of Americans who are going to lose coverage, and that's why the states are very focused on this. The federal government is very focused on this, and we're very focused on making sure that our members understand the process, and if they are still eligible, they're able to renew. And if they're not, if they're eligible for products on the health insurance marketplace, for example, as an alternative, that we help connect them to that as efficiently as possible.
There was a lot of discussion here earlier this year by investors about the reimbursement rates coming out of the Medicare and Medicaid programs. I know we did finally get that announcement in April, I believe, and it wasn't necessarily as severe as what the market had priced in, but there are some longer-term trends here that I think have worried investors about whether those reimbursement rates do continue to trend down.
Yeah, I think in general there is pressure to control costs in healthcare. It's something we care a lot about. We are essentially stewards of taxpayer dollars because we are in government-funded programs. And so for us, it's really about how do you deliver the highest quality outcomes at the lowest cost. And I don't think that that is orthogonal at all to what the government is trying to achieve. The question is, what's the best way to do that? And so particularly in these programs, looking at the data that tells us what the best programs are, what the best outcomes are, and how we can drive efficiency
efficiency in the program while still deliver high quality outcomes.
Your predecessor built this business from almost next to nothing to a behemoth that it is today. I am curious. He certainly had a vision and an ethos that did center around government-run programs and how that could end up feeding into a for-profit business. Is there any sort of discussion here about maybe broadening the focus of Centene beyond just government programs?
Well, our focus in the last year has actually been to double down and really take those 3 lines of business, Medicaid, Medicare, and the health insurance marketplace, and become the best in that space, because we think it is a growing space. We feel like it's a critically important space. And Michael built an unbelievably mission-driven company by focusing in that space. It is also, in my opinion, the space that's going to catalyze the most change in the healthcare industry, because if you can figure out how to deliver high-quality, low-cost outcomes in the most complex populations who have the fewest access to resources, those solutions are going to scale to the rest of the industry naturally.
I think we put our healthcare system through the ultimate stress test through the pandemic, and we saw parts of it that look pretty shaky, frankly. Are we making progress in reforming that, and what does that mean for Centene? What's the role of Centene in helping us do a better job at providing health for the American public?
Yeah, I think the pandemic taught us a lot about ways to deliver healthcare in a more affordable medium. So think about telehealth, the idea that that can solve for pent-up demand, it can solve for supply issues. For example, behavioral health, right? Behavioral health is a huge issue, even more so now after the pandemic, a shortage of behavioral health providers. But if you can leverage telehealth, you can extend into areas where they have supply shortages or out into rural populations. And so there's great innovation that came out of the pandemic. But again, the view that we have at Centene is that if you can prove out those innovations across 28 million Americans, and again, Americans who do not always have, they're living below the federal poverty line, that those solutions are going to be scalable and durable in the long term. So that's the opportunity we have, is actually to drive and scale innovation.
Where are you seeing healthcare costs increase the fastest right now?
Behavioral health is one of those areas, partly because of the demand. But it's interesting, actually, the pandemic has showed some structural changes. So within the Medicaid population, we've been seeing a suppressed level of emergency department visits, partly because that historically was sort of where the Medicaid population, the adult Medicaid population, would go for primary care. And we've been able to redirect and sort of reconnect them to primary care locations in a more convenient way, which is obviously a much more cost-effective, higher quality way of getting care.
Some of the care options out there that I guess either got put off or completely suspended during the pandemic for a variety of reasons. Some of the stuff that I guess falls more into the elective category, if you will. We've seen a tick up in that in terms of the number of patients coming back in for those procedures. How does that affect Centene?
So we track the pent-up demand actually through the waves of the pandemic. And one of the things that we saw is that clinicians got better and better as we went through sequential waves of working through that pent-up demand actually through the waves of the pandemic. And one of the things that we saw is that clinicians got better and better as we went through sequential waves of working through that pent-up demand. And so relative to more elective procedures recently, we commented on our Q1 call that we were seeing utilization in line with expectations. I know others have pointed to more recent trends, but it's something we watch pretty closely.
You said you've doubled down essentially on the government-provided health care. Where's the growth opportunity for Centene? Is it in market share? Is it in cost control? Is it a top line? Where are you seeing long-term market growth?
Both. So a belief that we can, by being focused, we can be more efficient in how we deliver care. We can reduce the overall cost structure. But we also see really exciting both organic and inorganic growth opportunities in our core business lines. As we think about the budget pressure you talked about coming out of the government, the idea that in a managed model, you have that public-private partnership that leads to better outcomes. It leads to more cost efficacy in the system. And so being differentiated in that space gives us the right to expand in each of those areas.
Where is your competitive advantage?
Being local. We have employees who live and work in the communities that we serve. We have foster parents designing our foster care programs, and healthcare is local. It is best delivered local. It's best delivered culturally sensitive care, and that is has been the hallmark since Michael started the company.
Thank you so much, Sarah. It's really great to have you with us. It's so interesting. It's Sarah London. She's Centene CEO. And so, I mean, this is an important part of our economy, obviously.
Yeah.
Another important part is going to be housing. Tomorrow, we're going to talk to housing because with all that housing slowdown, right now, not so much.
Well, it depends on where you're looking. Yeah. Right. You saw those new home sales.
Yeah, exactly.
Yeah.
Exactly. So we're going to actually get a chance to talk to Nancy Vandenhouten. She's Oxford Economics senior economist. Then on Friday, we'll be talking with Sheila Bair. She's the former FDIC chair. You know what that's about?
The stress test.
You got it. Bank stress tests. They're coming out.
Yeah.
We're going to be curious to see what that shows.
All right. We're going to be all over that. Full coverage of that on Wednesday. And, of course, be sure to check out David Weston, 6 p.m. every Friday here, Wall Street Week, and Wall Street Week daily segment every day around this time. As we get ready to reset here for the final hour of trading, stocks, believe it or not, setting up for what could be the best day for June. Economic data supporting some of the valuations here, and now the big question here is whether corporate fundamentals support that as well. Stick with us. A lot more coverage coming up from New York. This is Bloomberg.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Live from the Bloomberg Interactive Brokers studio, streaming on YouTube and Bloomberg Originals. I'm Carol Masser, along with Matthew Miller, of course, in for Tim Stenevec on this Tuesday, June 27th. Kind of feeling on the equity side of things, Matt. Once again, everything is awesome.
Everything is awesome.
And
you know why? Well, part of the reason, because I was looking at the S&P, and the biggest winners are like cruise ships, Carnival, bouncing back from yesterday.
You're stealing my top of the simulcast, buddy.
And, well, you can still do it then. And airlines.
Yes.
And I think a lot of it has to do with the realization that nothing is going to push crude prices higher.
Yeah, I was going to say that's a really significant one if you look at the energy trade. I've also been watching Apple. It's on track for another record close. 187 was the last record, June 22nd. So right now we're at 188 and change. So I'm keeping an eye on that one. Big tech in a big way.
We're watching Apple at $3 trillion, with a T, dollars, right?
I was reading a research report that said, $4 trillion, it's possible.
Yeah, was it by Cathie Wood?
No.
Okay.
Just watch it, buddy.
Okay.
Just watch it. All right, coming up, not so good. Little enthusiasm, a lot of enthusiasm with some of the big tech names. Not so for UBS, getting ready to cut more than half of its Credit Suisse workforce. Staggering, not surprising, a Bloomberg exclusive, but we're going to talk about that. And also surprising, Matt, though, or it is surprising, this is, strength in the U.S. housing market.
Yeah, well, not that surprising since Jerome Powell, the Fed chair, told us the market had bottomed. Right?
I guess.
At the last meeting.
But people weren't buying for a while because of those high mortgage rates.
Yeah, the interesting thing is that it continues to float higher, but I don't think there's a lot of transactional. There aren't many transactions.
Because I'm not going to leave a 3 or 4% mortgage rate behind. Hey, we've got a great voice, the founder and CEO of Chavo Real Estate. We're going to get into the office property markets with him. Mark Patricoff, too, works with Venus Williams, Aaron Rodgers. We're going to talk about the business of sports.
I'm looking very much forward to that.
We are, too. Right now, we're looking forward to joining our TV colleagues, talking about the markets. That's because Countdown to the Close. It starts right now.
Countdown to the Close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is the Countdown to the Close. About 60 minutes left to go here in the trading session. Romaine Bostic joined now by Scarlett Fu, as well as Carol Masser and Matt Miller. Welcome to our audiences across Bloomberg Television, Bloomberg Radio, Bloomberg Originals, and those folks streaming on YouTube. Carol Master, the sentiment over the last, 5 or 6 sessions was relatively dour. Today here on this Tuesday, we're looking at stocks, at least on an aggregate basis, setting up for the biggest gains all month long.
Yeah, I'm watching the tech sector, Apple in particular. Matt and I were just talking about it. It could hit at another record close in today's session, so keeping an eye on that. I've been also watching the cruise lines in particular. It was a tough day for Carnival yesterday. Investors, even though they outperformed in their latest earnings, investors wanted more considering the run-up that they've seen in that share price. Well, today, you've got cruise lines and Carnival rallying. Basically, you had a lot of analysts come out on Carnival, and they said their price targets, they increased it for Carnival after that earnings. Morgan Stanley saying the company's balance sheet risk is lower, and Stifel is positive on Carnival's adjusted EBITDA outlook for the year. So if you look at hotels and cruise lines, 7 members in that index, they're all higher, 3.6% for the group overall. Carnival, a gain of almost 8% today, Matt. Norwegian's up almost 5%, and you've got Royal Carib, it's up about 4%.
Yeah, and the airlines are all doing well. I think it's got to help that crude prices are lower and just don't look like even a surprise production cut is going to help them too much. I'm really focused in on the home builders and the housing segment because we had S&P, CoreLogic, Case-Shiller data out showing that month over month at least prices have risen, and you do see Lennar, Pulte, Horton all gaining. I took a look at the Case-Shiller index here, and you can see that we had a much bigger drop in the Great Financial Crisis. In fact, a 27% drop in home values. Now we've only seen a 4.5% drop in home values. And remember, Fed Chair Jay Powell told us last week that the housing market has bottomed, so there's nowhere to go from here but up.
All right, well, some of the data that we got today, both on home sales as well as consumer confidence, that did put a bid under stocks. And S&P 500 up 1.2% on the day. The NASDAQ indices flirting with what could potentially be a 2% gain. Meanwhile, the Dow Transport's up almost 3% here on the day. In fact, all of the major indices right now, Scarlett, look like they could potentially close out the day with their strongest gain for the month of June.
Yeah, you look at an intraday chart of the indexes today, it just goes straight up from left to right. I'm looking, of course, at the sector performances, and a lot of green there with the consumer discretionary and tech, each up by more than 2%. That, of course, reflects the cruise line operators, as Carol was just telling us. Within tech, a lot of strength there as well. On the downside, you've got healthcare off by 0.2%, mainly because of Walgreens and CVS. And energy stocks, Matt, you mentioned oil prices falling. Energy was lower earlier, but even they have turned around.
Yeah, it's interesting.
Yeah, and of course, we look at some of the individual movers. Some of the bright spots are in big tech. Amazon having a pretty good day, up about 1.7%. We were just talking, of course, about some of the other stories in the travel space with the cruise lines. Delta Airlines up more than 6.5%. Best day for that stock going back to October of last year. But a couple of down spots to talk about. Walgreens came out with their earnings. Those shares down 9% here, a revision to the downside in their full year forecast. A lot of concerns here about a slowdown. Remember, they had really benefited from the pandemic, but some of the bloom coming off that rose there, and the adjustment, and more importantly, not just an adjustment in terms of what they sell, but an adjustment on the cost side may actually need to be in the cards. And keep an eye on DaVita and Fresenius here, of course, 2 big providers of dialysis. We're learning that the Medicare and Medicaid services program here in the U.S. Considering another revision here and some of the reimbursements that they give to those companies. Meanwhile, back to the bright spots, believe it or not, well, Bitcoin is a bright spot. It continues to climb higher, still camped out around that 30,000, 31,000 level here. But a lot of discussion right now, not only about that BlackRock ETF, but now Fidelity apparently also potentially throwing its hat into the ring. A lot of speculation out there right now, guys, here about what those companies might know that individual investors might not.
All right, so Bitcoin up. You've got Apple possibly closing at another record high. We continue to see the tech group really support the overall broader market, really outperforming once again in today's session. Having said that, it makes you wonder, okay, is it time for it to take another breather? Lori Calvasino weighing in on this, head of U.S. equity strategy over at RBC Capital, and she says basically staying exposed to tech still makes sense.
I would still stick with tech names. I do think that NASDAQ is getting a little bit overbought. If you look at the CFTC data, we're hitting new highs on NASDAQ mini positioning. That being said, I don't think you have to sort of throw all the growth stocks out at this point. A sector like communication services, where a lot of the internet names are, those earnings revisions are starting to weaken. They're actually staying stronger in tech proper.
All right, Laura Calvasina over at RBC Capital Markets. I'm just checking out the NASDAQ 100, Matt. It's up about 36% year to date. And, you know, we're not quite RSI, relative strength. We're not quite overbought. We're a little bit low, but we're getting back up towards that level once again.
Yeah, we definitely see tech stocks outperforming in terms of the gains on the NASDAQ. If you look at the Dow Jones Industrial Average, you don't see nearly as many gains. So the old economy stocks not doing quite as well. And you also see in terms of fixed income, a little bit of selling with yields rising, so maybe people feel more comfortable to take more risk.
There is supply coming into the market when it comes to treasuries as well. I just want to go to something that Emily Grafeo pointed out in the MLive blog, which was really interesting, which is that the Goldman Sachs basket of most shorted stocks is up 4% on the day. We don't know the actual names in that basket because it's proprietary, but it's notable that anything that people were bearish on is doing particularly well today.
Yeah, I mean, I think this gets back to the question of whether some of the rallies that we've seen over this month really had to do with a little bit of a short squeeze. I guess some folks not only being squeezed out, but more importantly, being squeezed back in.
I'm beginning to think once again about this Goldilocks economy. I mean, does somehow Jay Powell and the Fed really engineer continuing to raise rates, bring down inflation without causing some kind of severe deep recession? And I do wonder if maybe that's what, you know, you look at the housing data and the housing price data this morning. I do wonder if somehow he's maybe going to be able to pull this thing off.
The soft landing hopes to dream on, right? Live on.
Yeah,
right?
Absolutely. And maybe helped by the 30-year mortgage, right? Did you see that piece?
That was a great piece.
By Alison Schrager. So other countries don't have this, and if their rates rise, for example, in England, you have to go out and refinance your home loan every few years. Luckily, we have this weird 30-year fixed rate mortgage that keeps us from facing that cliff edge, even though there will be fewer transactions in the market.
The interesting thing, though, about the column that Alison Schrager wrote, too, though, is that she did raise some concerns here that structurally, if this continues longer, it actually maybe takes some of that economic activity out of the economy, meaning a little bit less dynamism. So whatever we benefit from that, there is certainly some sort of consequence.
Right, if you've got a great mortgage rate, right, for 30 years and you don't move, what does that mean in terms of economic
less dynamism?
Lost?
What do you do without the dynamism?
I don't know.
Life's not worth living without the dynamism.
Get rid of your 30-year mortgage, Matt. I have dynamism.
I'm glad. I can do without the dynamism. I like 3%, you know?
Don't we all? Don't we all? All right, guys, we're going to have more in less than an hour's time. Our cross-platform will continue. We'll count you down at the close on this Tuesday. Radio, TV, YouTube, and, of course, Bloomberg Originals. The four of us will be back at 4 p.m. Wall Street time for Beyond the Bell.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
All right, everybody, we're going to get back to our TV colleagues, talk more about the markets, and Matt and I will as well in just a few minutes. But we want to get to UBS Group because a headline roughly about an hour and a half ago, Bloomberg exclusive about how UBS is planning to cut more than half of Credit Suisse's workforce starting next month as a result of the bank's emergency takeover. So let's get to it. It's a story, as we said, that Bloomberg News broke. So Bloomberg News Wall Street reporter Sonali Basak is here with us. I should point out Bloomberg's Marion Hoftermeyer and team broke it. But Sonali, not a surprise, right? We knew there was going to be some cutting of costs, but walk us through it and what we need to know and what our audience needs to know.
Yeah, Marion and team really put a number around how steep these cuts will go. Remember, when you think about UBS and Credit Suisse, there was a lot of overlap. So cutting half of the workforce, you really have more than 30,000, almost 35,000 people that we're talking about across the world. This is London, New York, and even some parts of Asia that will be facing the cuts. Bankers, traders, support staff. Listen, the other thing to think about here is not only the overlap, but Credit Suisse had a very large investment bank and with a very significant risk tolerance. UBS had been de-risking for many, many years. Credit Suisse had ambitious plans for that investment bank, but we knew a lot of that was starting to unravel. And so it's a tough market already for investment banking. And when you think about bringing these two banks together, there's a lot of a reason you could see why UBS would really start to slim down what they have to become more profitable.
And it's already been so slimmed down, right? I mean, how many bankers had to leave in the wake of Greensill and Archegos. These are results of being riskier. And then, of course, we knew even before the forced takeover that the writing on the wall was there. So now they're left with, after a huge brain drain, right? Credit Suisse is left with 45,000 bankers. Yeah. And Marion Halftermeyer and team tell us they're going to cut 35,000. By the way, that's way more than half. Right? So it's a huge, I think, bigger than expected amount of jobs to be cut. And I just wonder where these bankers are applying. What are they going to do?
Yeah, and I think the point that we've been making all day also is that a lot of bankers have left. So UBS CEO just a couple of weeks ago said about 10% of Credit Suisse's staff have already left. And remember, you have Deutsche Bank, Jefferies, a lot of investment banks that have been taking on bankers. And this is the top investment bankers. But then double that down and think about how many wealth managers there are around the world also when it comes to Credit Suisse. There is some room. You have a lot of big banks in the United States. You have Goldman Sachs. You have JP Morgan. You have Citigroup.
Is there something going on, too, with the rise of private credit in terms of being able to put money into companies or private equity, and then you don't need as much M&A? I don't know.
Well, let me differentiate for a minute, because wealth management, you have those banks. The U.S. banks even are growing abroad. But again, there's only so many bankers you could take on. These are not, very cheap bankers to bring on. These are very expensive bankers. So then you also have the rise of private credit, and Credit Suisse had a huge leverage loan operation. So that is where the competition does come from. You do have private credit starting to lend to deals that Credit Suisse used to lend to. Okay. And UBS was very cautious in that business. Again, this is a business that banks can and have lost a lot of money on, and UBS's risk tolerance was very strict when it came to that business.
Wow. Probably no surprise, but nonetheless, those numbers are pretty staggering.
It's a little bit of a surprise, right? Because the estimates were for 30,000 job cuts, and now we know it's going to be 35,000. So it was already a huge culling of the herd, and now it's even worse than expected.
At a time when Wall Street is firing largely.
Exactly.
Yeah. That's 2, 3, 4
That's what I find interesting is if you add it all together across all the firms. All right. Thank you so much, Sonali. Thanks for making some sense of it. Bloomberg News Wall Street reporter Sonali Bostic. All right. We do want to get back to, Matt, the broader markets. Another earnings season in the U.S. just around the corner. So let's start with first Jess Metton, Deputy Team Leader for U.S. Equities at Bloomberg News. She's in our Interactive Brokers studio. So talk about the stock market. You've got an article out about it making a pivotal shift this month. Talk to us about it, Jess.
So this is specifically looking at Gina Martin-Adams and her team at Bloomberg Intelligence. They have a model known as the Market Regime Index. So it basically takes different clusters of periods of the market in 3 phases. So basically it goes red, yellow, green. Not surprisingly, we were sort of in this red regime for 15 consecutive months, obviously correlating with the declines in the stock market. But it just shifted to brighter times ahead. It's in the yellow phase now. Really the important part of that is historically that means that would bode well for U.S. equity returns over the next 6 to 12 months. And the reason is there's 6 different factors that are in this. So we've seen improvement with the number of companies in the S&P 500 that are trading above their 200-day moving average. Obviously, indexes, annual change to price to books. But the one thing that
is it reliable, this indicator?
So it goes back since 1996 is how far back that there goes. So obviously, over the last a little more than 25 years or so. Okay. But for them, it's usually been more of an economic regime indicator where that does bode well for the stock market. But you do have the caveats where the one part out of the 6 indicators that haven't turned just yet is when you are looking at what's happening with corporate bond spreads. So that's the one kind of caveat leaving out there. But typically that would bode well for those returns. And we've talked a lot about their other index. They have an economic regime index that we've talked a lot with Matt about in the past. They were thinking most of the economic pain was already been passed. So if you're looking at her team, they feel pretty optimistic about where the stock market
can we
headed.
See this indicator on the Bloomberg, the relative strength indicator and MACD? We can see these things, right?
Well, this is specifically their data. I can send it to y'all, but not everybody would have access to it. It's actually in their latest research note for their mid-year equity outlook, and I can send that to y'all.
Bloomberg Intelligence?
Yes, so this is, if you go to, say, Gina Martin-Adams' bio page, that's going to be on their latest research note.
All right, what I really like, I'm kind of like a plain vanilla indicator kind of gal, and I love things like earnings, and I know earnings can be manipulated, revenues not so much, but anyway, we're getting to Simone Foxman, who's a reporter at Bloomberg News. She's here in studio as well, because you've been looking at what's coming ahead for earnings. Talk to us about it.
It's always earnings season, isn't it? No, it's
so it is. It's like a rolling earnings season.
And it's true. So some of the companies that are reporting now have periods that go a little bit later, and so we've gotten a little bit more updated look at how the economy is doing. But we were looking at Walgreens today, reporting revising down guidance for the year pretty substantially in earnings. I think the interesting bit here is really saying there's two bits to this. One is the consumer health bit, and one is medicine and stuff. And so that they're saying that the impact of COVID largely gone. A better than expected respiratory season for us from a human level, but for them that's not so great because they're really moving into the healthcare space. And so I'm watching as well, looking for Rite Aid later this week, because they're having a real hard time from a credit standpoint. They do not know, or investors are becoming skeptical that they can pay down all their debt for.
I don't get it. I go
26.
into like these drugstores. I will say I'm finding more and more empty shelves. You go to the prescription counter and it's packed.
Yeah.
And so I don't get.
I don't understand the
don't
business
get it.
model either. I have to say, I'm not sure if it's just my experience, the Walgreens, the CVS's, the Duane Reade's, whatever, that I go into, not only are the shelves empty, but they're locked here in New York.
Everything's locked.
Right? And you can't get anything without forcing one of the employees to come around and unlock them.
Yeah.
And then
I've
there's
walked
a
out.
line,
I've
there's
walked out
a
'cause I'm
long
like, I won't wait.
line at the pharmacy. So it's like, get rid of all the other crap that you're going to lock up or forget to restock. By the way, it's also like the Duane Reade, someone at corporate needs to come and look at the one here on Lexington. It is in bad shape.
And in Jersey City.
Yeah, and I mean this is something we've heard brought up by lots and lots of retailers is they're seeing all these issues with what they call shrink, which reads as theft.
I call it mess. Oh yeah, I know the shrink.
But it's also our consumers, and I was speaking to someone who owns a shopping centers.
Yeah.
Do consumers feel comfortable in there? The mess actually has a huge important role to play. Does it look clean? Does it look nice? And
it's a
increasingly
junky shop
pushing
here.
back against that. But the likes of Walgreens have
One
gotten
man's
into-
perspective, Matt walking into, but I kind of same thing, my experience. And I have gone into some that are just gorgeous, like at 57th
Not
and
in recent times, because when I go into one of the chains, and I'm not going to be specific about Duane Reade or CVS, I feel like
57 and
this is
third,
a
there's a
company that's
gorgeous
fallen on
one.
hard times. They can't afford to keep their business looking ship-shape anymore. And I wonder if it's only in New York or if it's nationwide.
Well, this is why as we go through earnings, whether it's a company-specific story or there's something in the industry.
Yeah, I mean, I think there's both. You look at these kinds of names, they're both retailers and they're also in the pharmaceutical side, and so they have that response to healthcare. And for the most part, people are not seeing these same sort of respiratory illnesses that they were seeing for the last couple of years, which is a great thing.
It's a great thing.
But at the same time, they're looking for different kinds of medical services, and they're looking for all the elective stuff that they didn't do. They're looking for, let me take care of my preventative health in a way that I haven't
just
before.
want to know, why do I need a key to get a razor blade or like
a
shampoo
toothbrush.
or a toothbrush?
Deodorant?
I mean, come on. Help me out here. Simone Foxman, thank you. Reporter at Bloomberg News. Jess Matten, Deputy Team Leader for U.S. Equities with Bloomberg News. I'm kind of with you on this, Matt. All right, Carol Master along with Matthew Miller. We're just getting started on this Tuesday. This is Bloomberg Business Week on Bloomberg Radio.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:21 on Wall Street. We do check markets all day long at Bloomberg. UBS Group planning to cut more than half of Credit Suisse Group's workforce beginning next month as a result of the bank's emergency takeover. Tech mega caps leading a rebound in equities today, with the Nasdaq 100 index up by almost 2%. The S&P 500 halting a two-day drop. S&P higher now by 50 points, up just about 1.2%, very close to the best level of the day. The Dow up 225 right now, up by about 0.7%. Nasdaq Composite Index up 225 points, up 1.7%. 10-year yield 3.76%. We've got the 2-year yielding 4.76%. Spot gold down $8 the ounce to $19.15, drop there of 0.4%. And West Texas Intermediate crude down 2.5% right now, 67.62 a barrel. Certainly, investors have been keeping an eye on developments out of Russia, specifically what it means for Russian oil. Cameron Dawson is Chief Investment Officer at New Edge Wealth.
One of the key things that has been bullish for markets is the moderation in oil prices. Part of that is a function of Russia selling so much oil at discounted prices. So if we start to see something that could impact Russia's oil production or their ability to be able to continue to sell, that would be the key upward impact on inflation and thus downward impact on markets.
And you can hear more of that conversation on the Bloomberg Surveillance podcast. You heard Tom Keene there. You can download it wherever you get your podcasts. Delta Airlines boosting its 2023 earnings expectations as it capitalizes on strong demand and a drop in jet fuel prices. Delta shares, they're flying high now, up 6.5%. Among some of the other airlines that we track for you on a regular basis, UAL up by 5%, American up by 5.3%, Southwest up 3.9%, JetBlue surging 8.6%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, the conversation, first of all, Charlie, thank you. The conversation we're having behind the scenes here, we're talking real estate.
Can I just tell you something?
What?
I have a great uncle
What if I said
who
no?
passed away.
Oh, sorry.
He died a couple weeks ago.
I'm
and
sorry.
he was renting a penthouse apartment with balconies on both sides on 96 in Amsterdam, for the past 50 years. I think he was paying like $800 a month. And my brothers and I were always like, should one of us like move in with Uncle Bud and have him adopt us? But we failed. We didn't do it. We didn't get it.
Matt, what's up with that?
Rest in peace.
What do you do for a living? Did you know? Did you ever see, was it the Seinfeld episode? Remember when someone died in a lane or they all wanted the apartment?
Yes.
All right. We digress. But we want to talk housing because the U.S. is in what's traditionally the busiest home buying season right now. We got some home data today. U.S. home sales advancing in May at the fastest pace in over a year. So great roundtable to talk about it. Pat Clark is real estate reporter at Bloomberg News here in our Interactive Broker studio, along with Allison Schrager, senior fellow at the Manhattan Institute, Bloomberg opinion columnist. She has a column out about 30-year mortgages in the U.S., and we're going to get to that in just a moment. But Pat, set the stage in terms of the data and where we are in the U.S. housing market.
Yeah, well, we just had a solid increase in home prices from March to April. We're still down a little bit year over year, which is that's been a pattern we've had for the last few months with small monthly increases, but still down a tad. Probably indicates that we are bottoming out and that
the worst is over, you mean?
Well, yeah, the worst is over for home prices. I mean, the housing market. I mean, the housing market it's a market. It's two-sided. It's if you own a home, the value of your home is not going to go down more probably. If you are looking to buy a home, that's bad news.
It's amazing to me though that we're not going to go back down from here. I mean, if you look at the S&P Case-Shiller chart. From the beginning of the pandemic until now, prices have just absolutely soared, right? Because everybody wanted to get out of the city and COVID and we needed to distance. But now we don't have to anymore. We're like, calm down,
But
no
they
longer
talk about the
freaking out.
supply being low, right? In terms of the housing
supply, yes, the supply is really low. We're inventory is something just short of half of what it was this time in 2019. But what that really speaks to is that, yes, there was this... there was stimulus. People wanted to go buy a house in the country. People were forming households for the first time. But the prices were also supported by these really low interest rates.
Right.
And those interest rates are locked in.
All right, so let's get to Allison Traeger. Come on in, Allison, on your column today, where you talk about the 30-year mortgage could save the U.S. housing market. Lay it out for us.
Well, I mean, I didn't even realize compared to 2008 that almost everyone who's bought a house in the last 10 years has had a 30-year fixed rate mortgage, which means, and I'm one of these people, I locked in a really low interest rate during the pandemic, and effectively I'm never moving, and that's
Congratulations.
Yeah, exactly.
Yeah, you know, it's funny, we were talking about Fed policy and how it lowered rates. I was having a coffee with a member of the Fed board during the pandemic, and I was like, oh, I heard you bought an apartment. I'm like, yeah, it's great, paid nothing for it. And he goes, you're welcome.
That
is great.
Yeah. By the way, I just looked at the Case-Shiller Index. So from March of 2019 until the peak that we hit in the middle of last year, home prices rose 51%. That's insane froth. Like, how does that not come off?
Wait, what was the starting point?
March of 2019.
Okay.
Oh, I guess that's a little bit too early. I should have started March of 2020.
Okay.
The point is, though, prices have marched higher, and your column, Allison, kind of explains why we're not going to see a lot of movement back to the downside.
Yeah, because if you remember in 2008, like 30% of people had those adjustable rate mortgages. So as rates went up, they couldn't afford it. And in fact, all of a sudden they found they were underwater. And what's interesting is that pretty much every other rich OECD country is seeing big drops in housing prices, but they also mostly have adjustable rate mortgages too. So the fact that people like us are locked into these very low rates means we're going to be very reluctant to move, because, I mean, where can you go?
Can I just highlight
Wait,
one
Pat,
step?
did you lock in a low rate, Pat? No, Pat didn't get it.
Can I just say that one stat in your story, by 2021, only 2.2% of mortgage applications were for adjustable rate mortgages, while in 2022, 85% of mortgages were fixed 30-year. Like, that number, that's such a flip. It's amazing.
It is, and it's hard to imagine anyone, even if home prices do fall a bit and they find they're underwater with their mortgages, why people would leave. I mean, your monthly outlay is going to just only go up if you go anywhere, even if you downsize.
Demographics, though. I mean, people are getting older. I have nieces and, who are getting married, and they're buying homes, and they're starting families, and nephews, and so on and so forth. I mean, eventually demographics, people will be moving, or what?
Well, people are going to want to form households. People are going to need homes, whether that means, can they buy them? It seems like right now, in order to buy them, they're going to have to pay up to get them. They can go rent them, too. I mean, there's the other side of demographics is at some point people will
die,
or at least age out of a place where they want to live in a house in the suburbs and need to be in a community where they're getting more assistance. But that happens very slowly and over time. We imagine we imagine the boomers all dying off all at once, but it's not how it really goes.
Well, look at Torsten Slok from Apollo. He sent around a chart, I don't know if you guys are on his list, a couple of weeks ago showing the average new monthly mortgage payment, and it goes back 20 years. So over the past 20 years, we've been bouncing around between $1,000 and $1,500, and now it's $3,000. So the current average new mortgage payment, average across the country, including the middle, is $3,000. That's insane.
I remember when we bought our house years ago, decades ago, and it was like the mortgage was the same as our rent. Like, it was just such an easy transition. Having said this, Allison, I think about broader economic implications. If people have great 30-year mortgages like yourself and you ain't moving, what does that mean in terms of economic activity? Because when we buy a house, we tend to buy a lot of stuff. There's just an economic activity component as a result of that movement.
So you mean like people buy other things to go with the house, or are going to want to maybe as well do renovations, stuff like that?
Home Depot, real estate agents, commissions. I mean, everything you can think of associated with buying a house or forming a household, right? That kind of activity is maybe going to lessen substantially, right, if we don't see a lot more transactions.
Yeah, and that way I don't think, anyway, the 30-year mortgage might save us from a housing collapse. I don't think it's all necessarily good, because anyway, it might save us some short-term pain. It's also good to move. Like, if you're thinking, I want to move to another city for a better job, but the housing costs are just too high because you have to sell your cheap house and go to something with a more expensive mortgage, maybe you won't, and that might make the economy less dynamic. And as you say, younger people forming households might be priced out. That's not good either. So I think we're giving up some short-term pain, but might end up with a sort of just less dynamic economy in the process.
So your takeaway was the 30-year mortgage has kind of saved us from falling off a cliff edge right now
versus other countries, right?
versus what you see in the UK. But in the long term, we're going to lack that dynamism that has made America so great.
Or we'll be less dynamic than we otherwise could be. We're always more dynamic than the UK, but I mean,
True.
It's all relative.
Brexit.
That's always dynamic. Pat, but come in terms of when you look at the residential real estate market, are home builders getting ready to amp up, buy land and build, or what?
It's a good time to be a home builder because you're not competing with existing home inventory, right? So I think certainly builders are feeling optimistic and see a great opportunity. What level they actually produce homes into, I guess, is a question. And you know, they got burned 15 years
I feel
ago.
like they're so cautious.
Along with the rest of us, and they've kind of their business model operates in a way where they're taking less risk, but also are less nimble in terms of capitalizing on opportunity.
Home builder stocks are up almost 50% this year.
Yeah, they're doing very well.
Been on a tear. Okay, thank you. We didn't talk about the Manhattan Loft, 63% discount. How did we not do that?
True. Jennifer Epstein has a great story on the Bloomberg terminal about a 5,800 square foot loft that may sell for $4 million, which is pretty low for such a gigantic pad because there's a renter in there that's going to stay forever and only pays $2,300 a month in rent.
That's how it works in New York City. All right, Pat and Allison, thank you so much. All right, let's get a check on world and national news. Heading to D.C., our 99.1 newsroom, and Nancy Lyons. Hey, Nance.
Hey, Carol. Negligence, misconduct, and outright job performance failures, they are all getting the blame in a new report on Jeffrey Epstein's jailhouse death. In a social media video, Justice Department Inspector General Michael Horowitz says New York prison staff should have known that Epstein was laying the groundwork to take his own life.
Had Epstein's cell been searched as required, it would have revealed that Epstein had excess prison blankets, linens, and clothing in his cell. MCC New York staff also failed to ensure that the institution's security camera system was fully functional, resulting in limited recorded video evidence.
The Inspector General's report says there's no evidence to contradict the FBI's finding Epstein hanged himself in his cell. Well, it seems to be getting more dangerous just to walk in this country.
A new report from the Governor's Highway Safety Association shows at least 7,508 people were struck and killed by cars while out walking in 2022. That is a 41-year high based on preliminary data from 49 states and the District of Columbia. The New York Times reports pedestrian deaths have jumped 77% from 2010 to 2021. The report says risky driving may have increased since the pandemic, and there may be a lack of enforcement or awareness of laws meant to keep pedestrians safe. In Washington, I'm Nathan Hager, Bloomberg Radio.
Americans are feeling much more confident about the economy. The Conference Board's Consumer Confidence Index jumped more than 7 points in June. That's its highest level since January of 2022. And Ryan Seacrest is apparently taking on another new job. The New York Times is reporting he's been tapped to be the next host of Wheel of Fortune, succeeding longtime host Pat Sajak, who plans to step down in 2024. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 3:40 on Wall Street. We do check markets all day long. At Bloomberg, we have got the Dow, the S&P, NASDAQ 100 index, and the Russell 2000 trading very close to session highs. 20 minutes to go ahead of the closing bell right now, though. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bailey Lipschultz.
And good afternoon, Charlie. As you said, stocks are trading higher, led by a strong rally in big tech. The Dow is up 215 points, S&P higher by 50, with the NASDAQ gaining 230 points. The U.S. 10-year yield is at 3.76%, and small caps are higher by 20. 10 of the 11 main S&P sectors are trading higher, with tech and consumer discretionary each up more than 2%, while health is the only group in the red. NASDAQ biotechs fall 1%, transports rise 420 points, semis are higher by 130, while the VIX is lower by 4%. Leaders in the Dow, Intel, Home Depot, and Microsoft, while Walgreens, 3M, and Amgen are the worst performers. On the earnings front, Walgreens sank 10% to a 12-year low after cutting its 2023 guidance, and Delta led airlines higher after a strong profit outlook. Lordstown Motors plunged after filing for bankruptcy, and Eli Lilly gained on optimism after data for its weight loss drug. In deal news, KKR will buy Circor for $1.7 billion after boosting its offer. And wrapping things up, look for earnings from Jefferies after the bell. Live from the First Word Breaking News Desk, I'm Bailey Lipschultz. Charlie?
Okay, we thank you very much, Bailey Lipschultz. And to hear live breaking news over your Bloomberg, type SQUAWK, SQUA on your Bloomberg terminal. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, we've got just about 17 minutes left in today's trading session here on this Tuesday, June 27th. And as you heard from Charlie, equities definitely on a rally, outperformance among the NASDAQ 1.7% higher. And maybe some expectations that the upbeat U.S. economic data, that the economy maybe won't fall apart, or if we get a recession, it'll be easy. But we have seen also rates moving up a little bit today, Matt.
Right, and the concern, I think, if you're buying into this market, is that rates need to rise further.
Yeah, but maybe,
as has been indicated by Jerome Powell and the Federal Reserve dot plot, but the markets don't seem to buy it.
Yeah, all right, so let's get to it. Christopher Zook is with us, founder, chairman, and chief investment officer of CAZ Investments, works with endowments, high net worth individuals, and family offices. He joins us on Zoom in Houston. Hey, Chris, good to have you back with us. First up, got to ask you about Houston temperatures, Texas records. Talk to us about the heat and the stress, the grid stresses, because it's something we're going to dig into a little bit deeper, but I'm curious firsthand what you guys are seeing.
You know, it's amazing. We had a very actually mild start to this spring in the early part of summer, and then it has really hit with a vengeance here the last couple of weeks. You know, the grid is under stress. What I will tell you is that most of the things that were done after the freeze that we dealt with in 2021 have really improved the health of the grid, and the leadership of the new leadership that has taken over there has really done a very, very good job. So far, even though it is very hot here, it's 72 degrees everywhere you go, your car, your office, and your home, because that grid is very much intact.
All right, so you're staying cool with the AC on. Markets are hot right now. We're up again today, or we've broken the losing streak of the last couple of days. 1.2% on the S&P, another 1.75% on the NASDAQ. These tech stocks continue to run. How much longer can this go on, Chris?
You know, it's hard because of the fact that the market could be anticipating either a soft landing or an economic recovery on the other side, or the market could just be flat out wrong. And right now, it feels like we have this huge dichotomy to where in the S&P 500, 20 names have made up over 90%. 4% of the names have made up over 90% of the performance of the S&P 500 year to date. So we have this dichotomy where it looks like the bond market is wrong because the stock market is going up. I personally believe, and we believe as a firm, that the bond market is right and the stock market is wrong, and that this is going to end badly over the summertime and the fall as the recession really does arrive.
Having said that, if I look at the S&P 500 major industry groups, most of them are up on the year. And yep, it is some of those big tech names that are definitely leading the way. Communication services, that oddly named group, but nonetheless. But consumer discretionary, industrials are also gaining on the year. Materials, we were for a while, it feels like, Chris, talking about some of the plain vanilla old industrial stocks that were leading the way, and we were seeing some rotation. So having said that, does that not speak to you that maybe things are a little bit more broader in terms of the outperformance? And maybe it makes sense for tech to be such an outperformer and big influence, considering our world is so much tech.
Those are very fair points and very fair questions. And at one point, there was the appearance, based on what was happening in the bond market and in the stock market, that the Federal Reserve was going to be able to thread the needle and to be able to manufacture a slowing economy, beat inflation, and then at the same time not destroy earnings and profit margins. Really doesn't look like that is the case right now. But FOMO is kicking back in again, fear of missing out on the rally that is causing people to go, okay, what is not absurdly expensive? And so you are seeing a little bit more participation, but the actual indices themselves, they're still not performing like you would expect them to. And when you look at what the overall stock market has done, when you look at the S&P and when you look at the NASDAQ, what I will say is this. Most people right now believe the Fed is going to raise rates more, but yet they're trading stocks like that's not going to happen. That, to me, is a message of hope, and hope is a bad investment strategy.
I'm just going to tell you, Chris and Matt, that sounds like when my husband's like, yeah, honey, fair point, but, you're wrong. So it's okay.
Would I ever do that? No, I would not do that.
No, I hope you would. I hope you would push back. I hope you would. But anyway.
In terms of, I've seen this hope playing out when I go to lunch with Wall Street fund managers who are like, yeah, the Fed's got to cut. They're definitely going to cut, Do you expect Powell to, I guess at this point he'd be kind of reneging on his promise, because he said last week they're not going to cut for years.
I think that it is definitely wrong to think that the Federal Reserve is going to turn around and go the other way. The Fed is in one of the most difficult boxes that they have been in the last 40 years. If they raise rates too much, they know they're going to derail the economy and do so in a pretty significant way. But they may have to do that to whip inflation, to use the term of the early 80s. But at the same time, if they lower rates, because the economy starts to show that recessionary environment, and then all of a sudden inflation rears its ugly head again, then they look like they're completely incompetent. The markets lose confidence, and that is exactly what happened to the Federal Reserve in the late 70s, early 80s. They cannot lower rates until they know for sure that inflation has been beaten to the ground and that they have literally laid on top of it for a while to make sure that it's going to stay down. That is when they're going to cut rates, and that's probably not any time in the next 12 to 18 months.
Don't you feel like Jay Powell was just throwing cold water at everybody, basically saying, come on, guys, stop talking about cutting rates already. That just doesn't make any sense. We're not even close, But as I just texted or messaged to IB to Matt, data dependent. I mean, the Fed's going to watch the data points. If inflation gets down and settles, they certainly don't want a deep, deep recession either. Just got about 30 seconds, Chris.
Totally agree with you. And if they literally do see data that completely surprises people and then inflation is whooped, and then you don't see this bad recession coming, there's no reason for them to keep raising rates.
Hey, listen, 20 seconds, because you do make investment decisions. What's your favorite investment play against risk right now? Very quickly.
Absolutely owning the stakes in private asset management firms. They have the biggest tailwind. They have the best profit margins, the most predictability, and the most upside.
Got a favorite ticker?
So in the public markets right now, we do own OWL, Blue Owl. That would be our favorite as far as the names in the public markets.
Love that we got it in. Well, stay cool. Christopher Zook, founder, chairman, and chief investment officer at CAZ Investments, on Zoom from a pretty warm Houston. Carol Master, Matthew Miller, and this is Bloomberg Radio.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. UBS Group planning to cut more than half of Credit Suisse Group's 45,000-strong workforce starting next month as a result of the bank's emergency takeover. The NASDAQ Composite Index this year is up more than 28%. Analyst Dan Ives at Wedbush Securities says the run from technology is far from over thanks to the promise of artificial intelligence.
And I think when you look at Apple, Cook continues to play chess where others play checkers. And I think it's an install-based play, best install base in the world from a consumer perspective. iPhone 15, I believe, is going to be a mini super cycle. AI, this is just the start of what's going to be that drum roll in terms of what I view as an AI app store over the next 12 to 18 months. I think that's being overlooked as an AI play. I think Salesforce being overlooked from an AI perspective. I do think you have some pure play AI names, even like you look at names like Palantir and others that are really from a use case perspective.
And among some of the names he mentioned, Apple up 1.6%, Salesforce up by 0.7%, and Palantir rallying 5.2%. And by the way, you can hear the rest of that conversation on the Bloomberg Markets podcast at wherever you get or download your podcasts. Delta Airlines boosting its 2023 earnings expectations as it capitalizes on strong demand as well as a drop in jet fuel. Delta shares, they're up now by 6.7%. Those are our top company stories. This is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
Okay. Carol Messer along with Matt Miller. You know when there's a really interesting story? Matt and I are like, I'm pulling out the calculators and I'm doing math.
I don't need a calculator because I have a Bloomberg terminal, by the way.
Well, that's what I was
HC
doing.
Go?
I did a quick calculator off the terminal. Well, yeah, okay. No, what is it, HC?
HC Go, hand calculator.
Well, that's funny. Okay, you learn something every day here at Bloomberg. Having said that, this story among the most read about Wall Street's intern pay surging. Check this out, folks. Citadel paying $120 an hour. And we did some quick math, right, Matt?
Yeah, so $120 an hour, and in the story, they work out a 40-hour week. But you know that an intern at Citadel is not getting away with a 40-hour week. No. You're putting in at least 10 hours a day, I would imagine, not even including your lunch break, and then you're definitely working Saturdays.
So 60 hours.
So I'm saying 60 hours a week. At that rate, for $120 an hour,
$7,200 a month.
$7,200 a week, right? Is
Yes.
what you're making. So how many weeks do you work? Like 2 months, right? Or
so it's it's $28,800 a month at
Right.
that rate. So times 2, we're all doing our
if it's
calculations.
2 months,
That's $57,600.
Nice.
For 2 months.
For a 2-month internship.
Voila.
But the benefit is, of course, the benefit.
Can I be a Citadel intern?
Yeah. Well, here's the thing: you have a lot of competition. Apparently, Ken Griffin's firm, Citadel, and it's not just Citadel, but also Citadel Securities, they received 69,000 applications for their 2023 internship program.
Oh my God, it's like applying to an Ivy League institution.
Yeah.
Right, for school?
I mean, I want to apply.
So wait, did we figure out what it would be for a year? So 28, so that's $345,000 a year.
Yeah, for an intern. That's pretty good.
You know why it's silent? Because Matt and I have left to go apply to be an intern at Citadel.
We're typing up our Citadel applications right now. This is exactly what they want, right? Because here's the thing. If you lock in an intern at your firm, and the kids are going to love it, right? Because it's probably amazing.
Yeah.
Those kids are going to come back after they graduate, after they get their doctorates, after they get, their PhD, and they're going to work for Ken Griffin
Some of them
forever.
get sign-on bonuses, living stipends, and access to corporate housing.
Good for them.
Huh. All right, guys. Right now, we're heading over to our TV colleagues, simulcast on the markets, countdown, and beyond the bell. It starts right now.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Scarlett Fu. We're counting it down to the closing bell, here to help take us beyond the bell. It's a global simulcast with Carol Masser and Matt Miller. Welcome to our audiences across all of our Bloomberg properties, television, radio originals, and our streaming partnership with YouTube. Carol Masser, a pretty good day here across the board. Almost 2% gains right now for the NASDAQ, for the Russell. Dow Transports floating with the 3% run on the day.
Yeah, and I think that's a really telling index. But overall, we're seeing a lot of enthusiasm back in the marketplace. We've talked about housing before, folks. We had some upbeat housing data once again on this Tuesday, and you see the S&P 500 home builders index up about 3.4%. So we're continuing to see investors move into that sector, Matt.
Yeah, home builders have done very well. We have seen airlines do really well, as Romaine pointed out. We've seen cruise lines do really well, as you pointed out. So I think it's really interesting. It's not just tech leading this rally. Yes, the NASDAQ is doing very well, up more than the S&P, up a lot more than the Dow. But you have a lot of other sectors that are really helping to propel the S&P, so it's broad-based.
It's broad-based, and I look at the number of advancers versus decliners, more than 3 stocks higher for every one that is lower on the New York Stock Exchange. The broadest advance since about 2 weeks ago.
Yeah, I mean, I was just talking about, you look at the top 10 stocks in the S&P 500 that are moving higher on a percentage basis, not a single one of them falls into the tech sector. It's Carnival, it's Delta, American Airlines, FedEx even in there, Old Dominion, Freight, Matt Miller.
Yeah, well, I think that a lot of those are gaining ground because of the low fuel prices. For example, that was my take on FedEx.
All right, well, we get the closing bells here in New York. A Dow Jones Industrial Average going to finish the day 200 points higher, about 6 to 0.7% gain on the day. The S&P right now, right around 4,378 and change, about 49 to 50 points higher from where it was yesterday, a 1% gain on the day. The NASDAQ Composite higher by more than 200 points at 1.7%, while the Russell 2000 is going to close out the day higher by about 1.5%. All of the major indices right now are hitting what are going to be their highest levels, the strongest day, I should say, going back to early June.
Yeah, it does feel like some enthusiasm, to say the least, in the marketplace. You look at the S&P 500, look at the IMAP function on the Bloomberg, a lot of green, and we're going to get into the groups in just a moment. But having said that, Matt, if I look at the S&P, you've got 414 names to the upside, gaining ground on this Tuesday, 88 to the downside, 1 unchanged. So definitely overwhelming.
Which one's your favorite
sentiment. One? Which one? I don't know. I have to think about that one. I like Newell Rubbermaid. Like, that's an old-time company, right?
You and my wife.
Tupperware company, right?
Yeah, Tupperware.
Who doesn't need that stuff?
We got a lot of Tupperware at our house. All right, I'm taking a look at the groups, and you can see that IT now is leading the way. It was kind of neck and neck up to the bell because consumer discretionary was also doing incredibly well. And Romaine, as you pointed out, a lot of those names, in terms of percentage gains, were really at the top. Royal Caribbean is consumer discretionary. Tesla is also in there. Pulte Group is in there. Amazon is in there. You would think that's a tech name, right? But Amazon.com is in the consumer discretionary group. Of course, IT winning out at the end of the day. And I think it's interesting, Romaine, you pointed this out earlier, that energy wasn't a loser today, even though we saw oil prices come down. I will point out that if you looked at this GRR year to date, instead of on a one-day basis, energy is clearly the biggest loser of all the groups.
All right, so let's get to some of the individual gainers, if I may, in today's session. So we talked about Carnival. We've talked about the cruise lines really outperforming today. Carnival bounced back, really gaining back all of its lost ground yesterday after it reported earnings, and even though they outperformed in terms of their results, investors were disappointed considering the run-up that Carnival shares have had this year. But nonetheless, Carnival up almost 9% in today's session. You had a lot of analysts also coming out, increasing their price targets on the company, but the whole group was definitely having a bullish day. Let's get to Generac Holdings. This was your number 2 gainer in the S&P 500, just behind Carnival. That name up about 8.8%.
Texas, anyone?
Yeah, exactly. It's a portable generator manufacturer, seeing demand for backup power jumping amid that heat wave scorching in Texas. So we just talked with somebody out of Houston saying everything seems to be working, but nonetheless, there is a lot of stress on the grid, and so people are going to be tapping into their backup generators. So that one's certainly outperforming. It's up more than 40%, by the way, this year. Charter Communications, don't know if you noticed, but number 3 gainer in the NASDAQ 100. 2-day rally of about 8%, up 5% in today's session. Heavier volume than usual. This is the White House said yesterday that it's going to allocate more than $42 billion to provide affordable and high-speed internet access across the U.S. by 2030. So we saw investors, Matt, moving into that and some other names in that group.
All right, I'll pick up the decliners here because Walgreens was the worst performer in the S&P 500, lowering its full-year guidance, saying that there is less demand for COVID vaccines and testing kits, which is reducing foot traffic, while its transition to healthcare is taking longer than expected. CVS, which of course has moved faster than its rival to healthcare services, also falling in sympathy. Illumina, another big decliner, the gene sequencing company looking to cut $100 million in expenses by reducing headcount and its real estate footprint, especially at a campus in San Diego. And Thermo Fisher Scientific off by 2.4%. This is a company that makes scientific instruments and chemicals, and Barclays has lowered its price target to $590 from $610. The stock closing down 2.4% to a 7-month low.
Yeah, and I'll just add one more. Regeneron actually had an awful day, worst day going back to March of 2020, and that was largely on some news across the wire just a little while ago with the FDA failing to win regulatory approval for one of its key eye medicines for macular degeneration. Let's take a quick look at what happened in the yield space, because we did see a sell-off there on the back of that better than expected economic data. Remember, it wasn't just housing, it wasn't just consumer confidence. Even some of the business spending, the capital goods stuff was actually came in a lot better than expected here. So there are a lot of signs here that maybe the economy is holding up here, and that's causing a lot of shifts, not just in the equities, but of course in the treasury space as well.
Soft landing, anybody? I mean, it does make me wonder, you know, might Jay Powell and company be able to figure this one out?
No.
In terms of managing the economy, maybe not into a recession, maybe, you know, slower growth at some point, and you know, but nonetheless, keeping the economy and the momentum moving. I think we do have to watch any data points, though, when it comes to consumer spending, because it's so important to the economy.
Yeah, I mean, the consumer is key, but I think a lot of the help he's getting is with, as we were talking about, the 30-year fixed-rate mortgage. And then Torsten Slok sent out a chart today. By the way, I have a button on my Bloomberg for emails from Torsten Slok at Apollo Group because they're so helpful, showing that the quality of auto loans and the quality of mortgages that have been originated today and over the past year are so much better, such high quality compared to what we saw during the GFC, which is why we're not seeing the breakdown that we would have then.
So regulations worked.
Or companies have learned their lessons.
Yes, banks have learned their lessons, exactly.
You know, I was looking at the economic surprise index, and I was talking earlier about how it's been a straight line up. It's gone up yet again because of the data dump that we got today, and is now at its highest level since April of 2021. So the data continues to surprise, and people are saying, I'm not going to worry about the Fed.
Not going to worry about the Fed, of course. I don't know. I guess do that at your own peril. Obviously, we talk about some of the distortions heading into month end and quarter end, but this kind of sets us up, I think, for what's going to happen. I think when we come back from the 4th of July holiday here in the United States, and you get into an earnings season where you have to now refocus on some of those corporate fundamentals on the back of multiples that, at least for some of these names, are well above historical averages.
I guess I'm trying to balance out, too, that if inflation is easing and the input costs for a lot of companies are going down, then that maybe gives them some wiggle room in terms of maybe not having to let workers go, because that's what I really think I'm keeping an eye on as well, is the labor market.
Or their profit margins expand.
Right, exactly, right? They can maintain their profit margins and don't have to cut costs elsewhere. So I think that's what's going to be key for me in earnings in terms of what are their costs and are they able to hold on to workers, even if they start to see some softness in their business.
Yeah, and in particular, what banks say about credit quality and, of course, how people are paying back their loans, especially servicing their credit card debt.
I'm very focused on credit quality. I still have to buy my Dodge Challenger Hellcat Red Eye wide body, you know, and I got to take a loan for that.
Romaine,
we need a picture, by the way.
Romaine, maybe we should all go be an intern at Citadel.
Oh my goodness!
I heard they're paying pretty well over there.
$120 an hour. If you put in a 60-hour work, you're making $7,200 as an Intel in a week.
In a week, we figured out almost $30,000.
You get to live in Florida too.
Almost $30,000 a month. So you're talking about $60,000 in 2 years.
Right.
I mean, in 2 months.
In 2 months, yeah, that's pretty good for an internship, right?
Yeah, and they're
That's
signing.
good for a regular
they're
job,
signing
dude.
bonuses.
That's
They're signing
$350,000 a year.
Are you trying to tell us something? Are you Matt? Are you applying to?
Carol and I have already applied. The problem is we have such competition. Ken Griffin has gotten 69,000 applications for this year's intern class.
Is that a sign of the times? What is that?
I don't know.
You've got to apply for next year, Matt. That's your best hope right now.
Be careful.
I'll be 50. You think that's too old for an intern?
No, we can make a movie off of it.
All right. We got more data to come, guys, and we'll see how that plays out in the market. I know. Can you believe?
I know.
When did that happen?
I've got macular degeneration.
Our little boy has grown up.
He's young at heart.
All right, guys. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, and Bloomberg Originals. We will catch you tomorrow. All right, as we try to figure out when we should go apply to be a Citadel intern, in the meantime, we continue to kind of parse through economic data points, headlines on a lot of things. We talked about residential housing earlier with our team, and we know the current issue of Bloomberg Business Week is all about the office real estate market and noting that it's getting scary. But then we had SL Green yesterday selling a stake in a Park Avenue tower, a value of about $2 billion put on that skyscraper as a result of the deal. And that showed to be, or was looked at, Matt, as some optimism when it comes to the office real estate space.
Yeah, I think
in certain markets, certain areas.
I won't use the tale of two cities cliche, but clearly there's a difference, right? If you have a great office building on Park Avenue in a place where everybody wants to be, or if you've got one of the buildings on the 3rd Avenue Canyon down here that nobody wants to work in or will ever be able to live in, there's a very big difference in the value of those assets.
It's not apples to apples. Well, we have a great guest to comment on the commercial real estate world. With us is Michael Chabot. He is founder, chairman, and CEO of the International Real Estate Development and Investment Company that bears his name. His company owns the Transamerica Pyramid in San Francisco, bought that back in 2020, other properties around the world, and we welcome him in our Bloomberg Interactive Broker studio. Hello, hello.
Hello, good morning, good afternoon.
It's morning somewhere, isn't it?
It's somewhere morning,
is it?
yes.
Yeah.
Michael, here at Bloomberg, it's morning.
When Carol and I get our Citadel internships, have you got a place for us to hang out in Miami?
By the way, the Citadel play in Miami is something that everybody's been talking about because, you know, the move of Citadel to Miami from Chicago has been a big generator of kind of other companies moving there. This whole intern thing is a phenomenal marketing tool, right? Now you got every top
college grad,
coming to Citadel. But you know, when you're looking at the market, and you were talking about the SL Green deal, the SL Green deal is interesting. If you go through the details, a lot of it was actually a transfer of debt, right? So the Japanese firm actually took over a bunch of the debt. But the fact that
Which was great for SL Green's balance sheet.
It was amazing for SL Green, and the fact that the building is worth more than the debt was a miracle on that specific asset. But as you said, it's not even a tale of two cities. It's a building specific today.
Yeah, that's right.
And the separation between good and not good, or good and really bad, is huge. There's no more in between. It's either you're a winner, which means you're a trophy building, you're generating rents of $200 a foot plus. In that market's on fire, or you're dead. There's no in between because, as you said, nobody wants to go to 3rd Avenue because those buildings have expired. The idea that real estate lasts forever is something that people are now realizing is probably not true.
By the way, what do you do with those buildings on 3rd Avenue? Because we've heard from people that look into it, not only does nobody want to work in them as office buildings, but they cannot be repurposed as residential.
I'm going to ask you, when you open your fridge and you see the milk expired, what do you do with the milk?
Just throw it away.
Exactly. And that's what's going to happen with these buildings. So when we're looking at these buildings, we don't buy on 3rd Avenue because it's not our neighborhood. We only focus on super prime real estate. But at some point, the value of those buildings is going to trade at land value. And there will be an opportunity to demolish them and build a new office, a new building. It's not that nobody wants to live there, but you can't take bad stock and make, you know, you're not going to take the sour milk and make a cake out of it. It's still going to be a sour cake. And that's really the problem with a lot of these conversations about converting office to resi. It works in really specific cases with buildings that have the right column widths and things of that nature.
Have you been to the Ned, for example? You've been to the Ned in London?
Yeah.
It's gorgeous.
It was a bank, and now it's a really
gorgeous.
cool hotel with like 9 restaurants.
But once we take down the sour cakes, are we going to build new cakes, in other words, new offices, or are we going to do something else with that land?
Well, we're in certain cases where there's demand, we're going to build new office. I mean, I'm a big believer that the idea that everybody's working from home is nonsense. You know, pre-COVID, we all remember everybody wanted to be Google, Apple, Facebook. We all wanted big offices, hold hands, you know, and
we were
collaborate.
there years ago. I'm just going to say.
I want to say that.
No,
that
you really
every time
were.
I come to this office, this was built in 2005. What a visionary Mike was to do this, to bring people together, forces you to come together in London as well before you go to your office. It's brilliant, and he's a true visionary.
It's a fantastic place to work, and our new office in London, by the way, I think Norman Foster designed that as well.
So I just toured that actually with Norman. Norman's designing 4 buildings for us. He's also doing the Transamerica Pyramid in San Francisco, and a couple of new office buildings in Miami. The building is amazing. But just to go back, Carol, to your question, we're going to build office, we're going to build residential, we're going to build the right thing at the time,
Right.
but the value of the land will start making sense.
Go to San Francisco. You bought that Transamerica Pyramid back in 2020. I think it was $650 million. And I know you're putting a ton of money in to renovate it. Any regrets about that property? And help me understand San Francisco.
I'd buy it 5 times again if I could. It's a first thing, as I said, Schmo focuses only on elevating super prime real estate. It doesn't get more prime than the Transamerica Pyramid.
But what's going on in San Francisco? We have a cover story on Business Week. San Francisco's going through a really tough
So
time.
if you read the press, you know, and you think San Francisco is dead and it's about to sink and the cable cars are going down the ocean. You guys reported recently about the Transamerica Pyramid. We've signed multiple leases between $200 to $250 a foot in the pyramid. Now, that makes the Transamerica Pyramid the 3rd most expensive building in the country. More expensive than the building that SL Green just sold as far as rents, right? It's at the top of the market as rents. And this is in San Francisco, which is a market that in general has a lot of negativity. It shows you that even in difficult markets, there's a flight to quality, and we're getting the investment banks, we're getting the VCs there that are willing to pay if you give them the right thing. And obviously with Norman Foster, and we're investing hundreds of millions of dollars, we're seeing that. But San Francisco has obviously some existential issues that will eventually get solved. I think that there's a lot of eyes on us with what we're doing at the Pyramid, with how we're going to rejuvenate the park. We have the Redwood Park there, to really ignite that whole neighborhood, Jackson Square. That's going to happen towards the end of the year, early next year. So there's a lot of hope that that brings life back to downtown.
Did it just get ahead of itself also? I mean, I feel like we've been talking about the housing problems and situations, the expensive nature of San Francisco, a city like San Francisco, for years. So did it just kind of need to right itself, or is it the pandemic?
I think, look, I think it's a combination. It's the stars aligned in the wrong location in that sense, because the pandemic took a hit.
Yeah.
The largest groups that suffered from the pandemic, or in the sense from an office perspective, is the tech tenants, because they all of a sudden figured we can work from home. But that's all changing, right? You're seeing a change of that. And right now we're seeing, even in San Francisco, we're seeing Monday to Thursday, the card swipes right now. People are at the office. Friday is still quite quiet. But all that really means is you got to give people a reason to come. You got to earn the commute.
Our Ed Ludlow, who's in our San Francisco bureau, is listening and says, ask him what's going to happen to downtown San Francisco. Westfield and all the corporate real estate is empty. Everyone wants it rezoned.
So well, they're working on.
Thank you, Ed.
But again, Ed, part of the issue there is, as I said earlier, not every building works as a conversion to residential. San Francisco, from all market, needs it more than anything else because housing prices are out of control. Unemployment in San Francisco is sub 3% today, which is something really important to understand. People are there. There is going to be a back to work, but we will see the bad stock exactly like Third Avenue, as you were talking about the creators of Third Avenue. There are buildings that expired in San Francisco and in every market. Chicago is no different, and New York is no different. We have to get rid of the buildings that are not relevant anymore, and build new buildings instead of them. And that's a transformation. That's where we're going right now. COVID has accelerated all this thing that was gonna happen anyway.
I would love to hear your take on New York, because San Francisco, when I see that rents are going down there, it just makes me excited because I want to live there and maybe I can afford it one day.
So beautiful.
Miami, obviously, it is white hot. Not just Citadel. I mean, even before Ken Griffin thought about moving to Miami, everybody wanted to be there. But New York feels kind of dead. Even on this block, we had all of these big tenants downstairs, and those stores are empty still, right? J. Crew and Victoria's Secret, and
Uncle Bud's
they're all gone. So I just wonder what happens to New York.
We had the Container Store. That went away, right?
Yes.
We had H&M. It's gone.
We used to have Williams-Sonoma and Pottery Barn. They left, and I asked them, I go, why are you leaving? It's a great place to be. And they're like, it got too expensive.
Right. So
you
again,
got 20 seconds, then we're going to bring you back.
Okay. Well, there was an issue with obviously the cost, as you said. The cost went up. They couldn't afford it. The business interruption. But you're seeing, if you look at Madison rents went up It was $1,000 a foot down to 400. You're back at $900 a foot on Madison. There is a bounce back in the locations where people want to be.
Michael, sit down. Sit
tight. Sit tight.
Sit tight. And we're going to bring Ed in. Let him maybe ask you some questions directly and talk to Ed about some other stuff. Michael Chabot, founder and chairman of his own company. We're going to continue talking real estate and some other stuff.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:21 on Wall Street. We do check markets all day long at Bloomberg. Just getting the latest quarterly numbers out of Jefferies. Second quarter net revenue, $1.04 billion. Estimates, $1.04 billion after hours. However, Jefferies shares down by about 3.5%. Jefferies is increasing its buyback authorization to a total of $250 million. UBS Group planning to cut more than half of Credit Suisse Group's workforce starting next month as a result of the bank's emergency takeover. The stock market welcomed the latest data underscoring economic resilience, even if that means the potential for still tight Federal Reserve policy. The Dow, the S&P, and NASDAQ all rallied today, with the S&P up 49, a gain of 1.1%. Dow Industrials up 212, higher by 0.6%. NASDAQ Composite Index up 220 points, up 1.6%. 10-year yield 3.76% for the 2-year, 4.76%. Spot gold down $9.50 the ounce to $19.13, drop there of 0.5%. Bitcoin holding above 30,666 on Bitcoin, up by about 1.7%. And a retreat today for West Texas Intermediate crude down 2.3%, 67.66 a barrel. So again, recapping, stocks higher, big rally, S&P up 49, up 1.1%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. All right, we're going to continue with Michael Chavot. He is founder, chairman, and CEO of Chavot. Real estate, they are doing deals, and we're going to continue talking real estate. We want to roll into the conversation, though, also our Ed Ludlow, who, of course, is co-host of Bloomberg Technology, because we've had some news on the EV space. But before we get into it, you really kind of popped in some good questions on San Francisco. You're living in the San Francisco area. Do you buy that San Francisco is going to be okay?
I don't buy it in either direction. I asked the question because it's what the debate is here among everyone, residents, the industry. We had our Bloomberg Technology Summit last week, Michael, and the future of SF was everything that people were talking about alongside AI. And the mayor, London Breed, was here. And I think what we're talking about is downtown SF, the real estate you're talking about. And the mayor's proposal is that investors buy in and redevelop existing, or knock it down and do something new with what's already there. And my question to you, Michael, is how attractive is that as an investor to get involved in a project to reimagine what downtown SF looks like?
So you're asking the person that has the largest investment in downtown San Francisco. We have $1 billion invested at the Transamerica Pyramid Center, which is a full city block. I've had multiple conversations with the mayor about this whole idea. These things take time. It's not happening in 5 minutes. And the biggest issue San Francisco has, and has had for a long time, is bureaucracy of getting things approved, right? So now there's an emergency. They're trying to push everything quickly, which is good because I think that's going to make a change, but it's still going to take time. That is not going to be the immediate solution. There's a security issue in San Francisco that has to be dealt with. And it's this cycle where there's no people, so there's more crime.
How do you deal with that? It doesn't seem like that will be dealt with. I remember going to San Francisco 10 years ago to interview people around an Apple product release, and Chris Sacca had to break up a fight between two homeless people behind us because they didn't know who owned the joint, right? So, I mean, the homeless issue has been a problem for decades. A long time. That's not going to get solved.
Well, but you didn't feel the homeless issue when you had people on the street, right? Part of the issue with the homeless issue, when there's nobody on the street, then it's mostly homeless, and the ratio between homeless to non-homeless people is upside down. You feel it a lot more, right? And that's where you start seeing crime. That's where you're seeing drugs. I mean, this whole area in San Francisco that's problematic. But on the bright side, think about what's happening. You're asking what's going to change. What I think is going to change is that you have voters, and there's tremendous amount of pressure on the mayor and on the entire board there to make a difference. They've changed some of the people there, both on the education side and to fight crime. If you ask me if they're doing enough, it's probably not enough yet, but they're at least directionally going there because they know that there is no option. And unfortunately, the press has been very brutal in San Francisco, but it did give a kick in the butt to everybody there to move forward. But I think that what's interesting and why I find it fascinating is, as I said earlier, if we're getting rents between $200 and $250 a foot, which is twice the market in San Francisco pre-COVID. Pre-COVID, this building was at $65 to $105. Today, we're at $120 to $250, trending to $300. Right? That tells you that there is first thing that San Francisco is not dead. There is a belief at the top of the market, right, that people want to be there, right? So at the relevant real estate and the relevant locations, I think that we're going to see positive news, and like I said, there's a lot of eyes on us, towards the end of this year,
Right.
really to be to ignite downtown San Francisco with opening the pyramid and opening the park and opening that whole neighborhood.
Ed, I want to bring you in because initially we
Sure.
wanted to talk to you about what's going on at Stellantis, and I'm thinking about EV charging units, right? You've got another kind of Stellantis taking a page from Tesla's playbook in terms of lining up other automakers, and we can talk about EV infrastructure. Tell us the news, though.
Okay, so summing up the news from Stellantis, they're basically making a standalone power unit, much like Tesla has. So down the road, they can offer the charging at-home infrastructure, energy storage, and then the charging products. The thing is, we don't know anything about it. It's going to be through third-party partnerships, investments through their venture arm. And in this country, Matt's probably thinking, what is he talking about? In this country, Stellantis has no EV offering at all.
Yet.
So, they are so behind the curve here. I think the big question for everyone is, do they join the NACS club, which we discussed last week, right? They joined Tesla's technology standard. But this is at least Stellantis making squeaks. Raises a good point for Michael, though, Carol, which is, where does the energy come from? The private sector or the public sector? Always talking about the infrastructure bill, but, the private sector just gets going quicker. It just does it, like Tesla just did it in the case of its charging network.
Michael, how do you think about this stuff?
So we just completed the Mandarin Oriental residences in Beverly Hills on Wilshire Boulevard, and in California, obviously, as you know, EVs are extremely popular. I think a third of our parking spaces are actually all facilitated with private charging station, and we provide that to people that move in, and that's where you're seeing, as you said, the private sector is much quicker to react because there's a true ROI, right? If I have a guy that wants to buy or a family that wants to buy an apartment that the 4-bedroom and needs 3 charging stations, there's a true ROI in providing these facilities versus waiting for the waiting for the government to do it or waiting for public funds for that.
So it's becoming a bigger part, right? Is it becoming a bigger part of you as you develop?
For sure on the West Coast.
On the West
Coast. I think
Coast.
that it's really the mindset of the consumer. The West Coast consumer is very focused, and there's a lot of demand for EVs.
But don't you have to plan ahead? Like if you're putting up a building or re-engineering a building here in New York, if you're building something in Miami, don't you have to say like, okay, as Ed pointed out, Stellantis doesn't have electric vehicles in America this year, but in 2 or 3 years, they're going to have a ton of them. And so eventually, you've got to think 5, 10, 25, 30 years ahead, right?
Or do you?
I'm thinking about my internship at Citadel. No, but the answer to the question is yes. New York is a unique market. We don't build a lot of parking here.
True.
And
Good point. Yeah.
There was just a change, change that you see now with the taxes on traffic that was proposed yesterday here in New York City. But in Miami, for sure, Miami is another market that we are incorporating EV charging stations. The whole energy, the building we're building with Norman Foster in Miami Beach is a totally is an energy efficient building where very much like your headquarters in London, being environmentally friendly and environmentally neutral.
Where's your favorite place for opportunities or to build right now when you look around the globe?
And let me ask you about the U.S. versus the rest of the world on that note.
Good
because right now, America's going through a tough time. My wife's from Spain, and she has issues with our government and our people, but how do you look at it as someone who immigrated here also, 20, 30 years ago?
Well, that's a loaded question. We don't have that much time left to even answer that. But if you think about how other people how foreigners look at America, we're still looked at the best place to invest.
Huh.
And it goes back to the SL Green Deal. The Japanese just put tremendous amount of investment in here because the U.S. is looked at as the safest place to invest. Europe is a disaster from an investment point of view. They have, Spain, Germany. I mean, these markets have tremendous amount of problems. We all have the same issue with cost of capital, right? Cost of capital is expensive here. It's expensive in Europe. But there's the sense that the U.S. is a more advanced market and a safer market to invest. So we're seeing, we're partners with some of the largest German state-owned pension funds and insurance companies. They're still investing in the U.S. more and more now here than they are in their own backyard because they do have problems there that have to do with
Well, the
environment that
regulations are just off the hook
and for
over
years they were in very low return environment that now is with high cost of capital, it just kills you.
Yeah.
So, Michael, 30 seconds left here. So I'm not going to poo-poo some of the journalism that we've all been doing and the narrative out there about the concerns about office real estate, but do you think there is a crisis brewing? And just got about 30 seconds, 25.
It's as you said. It's not a crisis. It's not an overall market. There's a crisis in the B and C class office, and it's not a crisis that has expired. It's got to be demolished. It's got to be replaced.
I talked to someone who was overseeing kind of all of the old assets from like Sears and so on and so forth, and just saying, I'm so glad we're not talking about the demise of the mall anymore. Like we've moved on to office, and it just sounds like we're cleaning house at this point, just a little bit.
There's a reset, and like I said, old inventory out, new inventory in, and people are paying for it. The good thing is there's a lot of money out there to pay for new inventory.
Come back soon. This was really, really fun.
It was a pleasure. Thank you so much.
Michael Schvo, he's founder, chairman, and CEO of the company that bears his name here in our interactive brokerage.
And thanks,
studio.
Ed.
Yes, thank you, Ed Ludlow. All right, let's get a check on world and national news. Off to Nancy Lyons in our D.C. newsroom. Hey, Nance.
Thanks, Carol. The U.S. Supreme Court is rejecting a sweeping Republican-backed effort to remove state judges and administrators from their long-standing roles overseeing federal elections. Regarding a North Carolina redistricting case, the justices said the Constitution does not insulate state legislatures from state judicial review. Bloomberg Supreme Court reporter Greg Storr says if the court had ruled otherwise, it could have changed the entire voting landscape.
The fact that this was really a reaffirmation of the role that state courts are going to have going forward in federal elections was a remarkable victory given what might have happened in this case.
Bloomberg's Greg Storr says more rulings are expected on Thursday, with cases still outstanding concerning affirmative action at colleges and President Biden's college loan relief plan. Well, a group of House Democrats is pushing for the Supreme Court to investigate Justice Clarence Thomas.
18 Democrats, led by New York Congressman Dan Goldman, have written to Chief Justice John Roberts, urging him to set up an independent office within the High Court to probe Justice Thomas's relationship with billionaire Republican donor Harlan Crow. NBC News reports the letter accuses Roberts of providing no rationale or vision for the court to police its own ethics. Senate Democrats are mounting multiple efforts to set new standards after ProPublica reported Justice Thomas failed to disclose decades of gifts from Crow. In Washington, I'm Nathan Hager, Bloomberg Radio.
Georgia's Secretary of State Brad Raffensperger will be sitting down tomorrow for an interview with investigators from Special Counsel Jack Smith's office. Smith is investigating former President Trump's efforts to overturn the 2020 election. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, on Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 4:40 on Wall Street. We do check markets all day long here at Bloomberg. Tech mega caps led the rebound in stocks today. NASDAQ 100 index did rally today by 1.75%, up 256 points. Broad-based rally today. Russell 2000 small cap shares up today by 1.5%. The Dow, the S&P, NASDAQ all moved higher today. We had the S&P up 49 points, a gain of 1.1%. Dow Industrials up 213. That was a gain of 0.6%. NASDAQ today up 220 points, an advance of 1.65%. 10-year yield 3.76% with a 2-year 4.76%. Spot gold 19.13 the ounce, down by about 0.5%. West Texas Intermediate crude down 2.3%, 67.77 a barrel. Bottom line here, stock market did welcome the latest data underscoring economic resilience, even if that means the potential for still tight Federal Reserve policy. Well, as for the overall market backdrop, Christopher Zook is the Chief Investment Officer of CAZ Investments, and he was our guest right here on Bloomberg Business Week.
So we have this dichotomy where it looks like the bond market is wrong because the stock market is going up. I personally believe, and we believe as a firm, that the bond market is right and the stock market is wrong, and that this is going to end badly over the summertime and the fall as the recession really does arrive.
And you can hear more of that conversation on the Bloomberg Business Week podcast. You can download it wherever you get your podcasts. An arm of Canadian investment giant Brookfield has made a cash and stock bid for American Equity Investment Life Holding, valuing the insurance firm at about $4.3 billion. UBS Group planning to cut more than half of Credit Suisse Group's 45,000-strong workforce starting next month as a result of the bank's emergency takeover. And I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Carol Masser, along with Matthew Miller, live here in our Bloomberg Interactive Broker Studio on YouTube and also on Bloomberg Originals. Can I just say, Anthony Mancini of our team, our boss.
Of our team. He's the boss. That's not really in the team.
He's part of our team.
Okay.
I like to think of him as part of our team. When he's Citadel, they probably get time and a half to after 40 hours.
Yes.
So think about that. Okay, we're just obsessed with that story. Also obsessed with what's going on in Houston. We've been talking about how electricity demand in the second largest U.S. state surpassed the record set during the summer of 2022 as searing temperatures boosted AC use. We're, of course, talking about Texas, temps of 110 degrees Fahrenheit. So let's get into it, because what's going on is certainly we're looking at the grid, the stresses, if you will, and there's a great story on the Bloomberg by our Bloomberg News Power Extreme, by our climate crisis reporter Noreen Malik and team about what's going on in terms of our grid and really just how America's biggest power source, we're talking about nat gas, wasn't built for it. Joining us right now, though, to talk about the story is Elizabeth Elkin. She's interim team leader for Bloomberg's Power Team, and she joins us on the phone here on this Tuesday. So, Elizabeth, come on in on this story, because we talked with somebody out of Houston earlier about the temperatures. They're saying the grid is working so far, but there are stresses on the system, and nat gas to blame, or it just isn't ready for it.
Yes, absolutely. So we are watching the grid in Texas very, very closely. And like you said, Noreen had this fantastic story come out today. She's our grid expert. She has been looking into gas generation and how that might be impacting some of these blackout risks. So there's been a lot of gas generation come on in the last 15 or so years, right? Become cheap and readily available in the U.S. And it's, of course, cleaner than coal, right? So it's not inherently a bad thing that we have all this gas generation coming online, but it does tend to perform badly in extreme weather. And so obviously the last few years, we've seen it get really, really cold or really, really hot in Texas. And that can cause problems for these gas plants. And now we're looking at extreme weather appearing to get more and more common. And so it's pretty concerning.
So what's the problem with gas plants in cold weather? Do they literally like not have insulation, or does somebody leave the door open? I mean,
what's wrong?
Yeah,
absolutely. And it is actually a number of factors that hit all of these plants in a different way. So like the facilities aren't uniformly winterized, right? And so when it gets really cold, like different plants perform better in different temperatures, right? Some of them rely on like a single gas pipeline for supply. So like, say that pipeline has an issue, say it's really cold and that pipeline freezes, like that can be a real problem for that plant, right? And so part of the problem is that there's not one single problem that makes these plants either fail or not perform the way that we hope they perform, right?
Yeah, exactly. How was this story put together? Because you guys talked to a ton of folks inside the industry, really, who have a great vantage point. Give us a little bit of the insight about who you talked to.
Absolutely. So Noreen is an absolute expert on this. She has been covering these markets for years. And so she's been talking to people. She's talked to people in the plant. She's talked to traders. She's talked to people on the ground. She has talked to tons and tons and tons of people about this to pull together this sort of overarching industry thought on what's going on with the gas plants and why they don't always work the way that we want them to. And she did so much incredible reporting and so much hard work with her editor, Anne Riley Moffett, to pull together all of these different thoughts and ideas from the traders and from the people who work in the plants and from everyone sort of involved.
It's a very cool story because not only does she kind of uncover the vulnerabilities of gas power plants for us? I had no idea that this was part of the problem. But she also kind of walks us through, in a way, how these power grids work. We always talk about the grid, and I don't really know what that means.
It's just out there, right?
And apparently there are different grids that serve different groups, right? And she highlights, for example, the largest power grid in the U.S. serves 65 million people in 13 states and Washington, D.C. So it's great to learn all of this kind of wonky detail about how the power market works in the U.S. What's the upshot, though, here in terms of what has to happen? Does this mean we need to re-winterize or rebuild these gas power plants, or it's supposed to be a bridge solution, right? The idea is that natural gas takes us from dirty coal to clean renewables. So can't we just like kind of make it through to the other side?
Yeah. So that has been the idea. Has been gas is supposed to be sort of a bridge, right? Between we hear about coal and then we think like solar, wind, etc. And we are building solar plants and wind plants and all, but gas has grown by so much that it's tough to just say, okay, now we're just gonna not use these gas plants, right?
And we're the biggest gas producers in the world, right? The U.S.
Yes, absolutely. And so a lot of people have a variety of ideas of how we could help solve these issues. Some of them include like building more pipelines for some of these plants so that like if one pipeline fails, you can use another one,
right.
Keeping extra gas on hand, right, in case there's an issue like getting all of the gas that we need, which sometimes happens, or even like having backup fuels in case like they run out of gas. But it is just really hard to change a system that's become so prominent in the last 15 or so years. And so sorry, yes.
No, but in the meantime, the story points out that increasingly we're seeing more than 7 hours of power interruptions for U.S. households on average in 2021, more than double the rate reported in 2013. And as you guys also point out in the story, that polar vortex, remember back in January 2014? So that's when we, extreme weather's unusual, don't laugh, but it's almost 10 years since then, and we're continuing to see problems. So we haven't kind of figured our way around this. So that's worrisome. And
I can't believe 2014 is almost 10 years ago.
I know, right?
Listen, Elizabeth, thank you so much. Elizabeth Elkin, so glad we could get to this story. Interim team leader for Bloomberg's Power Team. We do want to point out Mike Bloomberg, founder and majority owner, of course, of Bloomberg LP, parent company Bloomberg News has committed $500 million to Beyond Carbon, a campaign aimed at closing the remaining coal-fired plants in the U.S. by 2030 and halting the development of new nat gas-fired plants. So we just wanted to point that out there. Check out this story. It's online and at Bloomberg.com. Really deep dive and explains so much. This is Bloomberg.
company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. UBS Group planning to cut more than half of Credit Suisse Group's workforce beginning next month as a result of the bank's emergency takeover. Sources tell Bloomberg bankers, traders, and support staff in Credit Suisse's investment bank in London, New York, and some parts of Asia are expected to bear the brunt of those cuts. Delta Airlines shares moved higher today. Delta was up 6.8% after boosting its 2023 earnings expectations. And with more on the story, here's Bloomberg's Steve Rappaport.
Charlie, Delta is capitalizing on strong demand and a drop in jet fuel prices at the outset of the busiest travel period of the year. In a regulatory filing, Delta said adjusted profit for the year will be at the high end of its prior guidance of $5 to $6 a share. It also raised its forecast for free cash flow and operating margin. International travel has expanded rapidly this year as most countries have dropped their last pandemic restrictions, helping to boost revenue for carriers. Domestic demand remains strong in the face of inflation and economic uncertainty, and the industry expects summer travel to challenge the record traffic levels of pre-pandemic 2019. Charlie?
And that's Steve Rappaport reporting. Wasn't just Delta today. As I mentioned, Delta was up 6.8%, but the other airlines flying high as well. Case in point, UAL up 5.1%. That, of course, the parent of United. American Airlines up 5.5%. We had Southwest Airlines up by just about 3.7%. JetBlue up by 8.8%. Those are our top corporate stories at this hour. This is Bloomberg.
This is Bloomberg Business Week with Carol Massar and Tim Stenivek on Bloomberg Radio.
Matt Miller in the studio for Tim Stenivek, Carol Massar alongside me. And we got a lot coming up in the program. For one thing, dark skies are coming back. And we're going to
talk about that
in a second over New York. And then we're going to talk with Jim Ellis, Assistant Managing Editor at Bloomberg Business Week on the Cannes, or is it Cannes? Cannes. The Cannes Film Festival, and what the advertising execs there are saying about AI.
I may not be able to get core and corp right, but I can get that right.
Okay, well, I never knew that. First, let's get over to Nancy Lyon. She's in the Bloomberg 99.1 newsroom in Washington, D.C. with your World National News. Nancy?
Thanks, Matt. The U.S. Supreme Court has sided with North Carolina's Supreme Court and voting rights groups and is upholding the oversight function of the state court to rule on election laws and redistricting that's overly partisan. Loyola University law professor Larry Levinson says the justices rejected the independent state legislature theory,
which would have allowed North Carolina to draw any kind of lines that they wanted for their election maps and would have given the Republicans full power without oversight by the state Supreme Court or even the federal courts.
Levinson says today's ruling cites a 220-year-old precedent. We're still waiting to hear from the court on affirmative action at colleges and President Biden's college loan forgiveness plan. Well, a new report points to prison staff failures in the death of Jeffrey Epstein. Bloomberg's Lisa Mateo reports.
An investigation by the Justice Department's Inspector General showed no evidence to contradict the FBI's determination that Epstein died by suicide. The report found that negligence and misconduct by New York prison workers failed to stop the disgraced financier from hanging himself. Epstein was found dead in his Manhattan jail cell in August 2019 when he was awaiting trial on sex trafficking charges. The case would have seen him go to prison for decades if he'd been convicted. In New York, Lisa Mateo, Bloomberg Radio.
Russian President Vladimir Putin is praising members of Russia's military and security forces after the aborted mutiny by Wagner Group mercenaries and their leader Yevgeny Prigozhin. Putin held a ceremony earlier today saying the Russian people and the armed forces had stood together against the rebels. A jet linked to Prigozhin arrived in Belarus from Russia today, 3 days after he abruptly called off his mutiny. Global news 24 hours a day, powered by more than 2,700 journalists and analysts in over 120 countries. I'm Nancy Lyons. Now back to you, Carol and Matt.
All right. Thank you so much. Nancy Lyons in our D.C. newsroom, World and National News. And speaking of that, we're getting ready. We were just talking a little bit about what's going on in Texas in terms of the heat and the erratic weather conditions we continue to see around the country. Well, smoke from Canadian wildfires are expected to obscure the skies here in New York and around the Mid-Atlantic starting tomorrow. And that's just weeks after we saw that happen here. I was out of town.
Oh, so you missed it. Right, you were down in Florida.
I was.
For the Invest or
Pershing Insight.
Insight.
Yeah.
Insight. I knew it was an I. For the Insight conference. And man, the skies here were this